Trading in Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Bleak outlook. UK Chancellor Jeremy Hunt lays out £55 billion of tax hikes and spending cuts as Britons face a record drop in living standards. Risk sentiment ebbs, Asia stocks trim gains as US futures turn lower after James Bullard raises his view on how high the Fed needs to hike rates. Plus, the ultimatum backfires. Elon Musk's demand for hardcore loyalty, well, it prompts an exodus at Twitter and is said to put day-to-day operations at risk.
Tom, this is a picture for the future. So we're seeing gains of about 0.2%. I know we look at technology stocks in Asia, but more than that, we again look for Fed speakers to give us a sense of what they do with interest rates after it seems that maybe potentially inflation can peak.
Yes, James Bullard coming out and outlining a new picture for the terminal rate of between 5 and 5.25%. So raising his view on where the terminal rate will end up. As Francine was saying, building on the chorus then of those Fed officials pushing back on any idea that you're going to get a pivot or indeed a pause from the Federal Reserve. Yes, the Asia story ties into this and the China tech story, and we'll touch on that briefly. But in terms of how things are shaping up in the first few seconds of the trading session this Friday, the Spanish IBEX is currently up 0.8%. The FTSE 100 gaining 0.4. Yes, some of the consumer data and retail data has come in stronger than maybe some market participants had expected. But longer term, given the picture that was outlined yesterday in that autumn statement, how sustainable is that really going to be? The CAC 40 over in France gaining 0.7%. Let's switch it on, see how things are playing out cross-asset then. We talked about this divergent picture between European equities and those in the US futures, pointing to currently range-bound after some heavier losses in terms of the futures, signalling losses as, again, investors adjust to those more hawkish comments from Fed officials. The story over in Asia was that Alibaba came through with some stronger results than expected, but that rally in Chinese tech over in Hong Kong fading. Currently, the pound is at 119. That's an upside of 0.4%. It's been a choppy session for sterling. UK assets, the gilts and the pound didn't really move a lot. There was a lack of volatility yesterday, despite that autumn statement. Now, the pound is gaining. The US 10-year, 376. Not a lot of movement across the yield curve stateside after the pop-up in yields yesterday. And Brent, $89 a barrel. So that's a gain of 0.2%. But you're looking for losses this week. Trading a little bit lackluster on questions, of course, about that demand holding up as we head into concerns, of course, or increase about a recession. Whether we head into one in the US is up for debate. Here in the UK, more baked in. Francine.
Tom, Fed officials continue making the case for further rate hikes to combat the hottest inflation in decades. Let's have a listen.
Even under these generous assumptions, the policy rate still isn't at a zone that might be considered sufficiently restrictive. To get to this sufficiently restrictive level of policy, we'll need to increase the policy rate further.
We are all united in our commitment to getting inflation back down to our 2% target. It's an open question of how far we are going to have to go with interest rates to bring that demand down into balance. We have raised interest rates a lot this year, so there's a lot of tightening in the pipeline. We have not felt the full effects yet, and yet inflation is still very high.
Well, that, of course, are some of the Fed speakers that we heard in the last couple of days. And I guess there's a bit of a disconnect, which we'll get to Ben Guttridge, about the fact that, you know, the market is expecting inflation to come down, but at the same time, they believe that we could be talking about cuts at the moment, which is not what the Fed officials are saying at all.
And this has been consistent over the last few months. Every time you get a bit of a rally in the equity markets, Fed officials come back out and say, hold on to your horses. We still need to see more data. But you're right, we saw that softer CPI print. The market's then betting on some kind of pause or pivot. Fed officials coming out very strongly and pushing back against that. Let's bring in our guest then in terms of the market analysis. Ben Gutter is Asset Management Director of Model Portfolio Services at Invesco EMEA. And Ben, I'm interested in your notes to us. You talk about the fact that you are still overweight equities. Make the case for that as we look at the terminal rate and the expectations. They're going to get a plus 5% handle on the terminal rate stateside. How does that inform your case for overweight US equities?
Well, a marginal overweight. I think we have to concede that it could be a difficult hold from here. Certainly, as you've just pointed out, every time the market enjoys a bit of relief, the Fed speakers do seem to come back and quash that. But I think what we're dealing with is, like, inflation remains the #1 challenge, and we've seen that maybe the trend has started to turn in the US. And if you look at sort of shorter-term data on goods prices, on rents, and indeed perhaps even on wages, still elevated, but starting to move lower, then of course the Fed can still come out and say, we've got to be alert to the inflation risks. But ultimately, I think like a downshift would be necessary in that environment, and markets can enjoy relief from that.
But Ben, so when you look at that disconnect, right, which is real and has been real for the last 12 months or so between the markets and what Fed officials are telling us, when does that disconnect stop? And actually, who's right? The markets have been proven right in the past.
Well, I mean, to my point about the marginal overweight equities, we think ultimately, the Federal Reserve will have to downshift, but that could take a few more months.
Downshift, you mean cut?
So slowing their pace of raising interest rates. Look, I think we've been so conditioned, I think, by guests on this show, by investors that I see, that the central banks just aren't here to help us anymore. And therefore, I think they don't actually have to do that much before the markets can, as I say, can enjoy some relief. And so a downshift in the pace of hikes to 50 basis points, maybe slower into Q1, H1 next year, could well be enough to see markets continue to enjoy a bit of relief.
And here's where you're against consensus again on the earnings picture, at least versus a lot of the guests that we speak to, which is that you think earnings actually hold up. As the inflation dynamics start to recede, you think earnings can hold up? Because we have a lot of guests coming on saying that the forecasts and the projections around earnings are still not realistic in terms of pricing in that downshift.
Well, again, this is, I agree, this is contentious, and there are certainly risks to this view. But yeah, I mean, if inflation does move lower, then there is some positive delta for real incomes there that could continue to support demand and continue to support earnings. And look, the labour market maybe is showing some signs of weakness in terms of sort of job openings, but really I think businesses are reluctant to lay off staff because it's so difficult to find them. So the labour market strength could endure whilst inflation falls, and that would be a good news story for earnings.
I mean, one of the things, and thank you to Valerie for bringing that chart up, where he's basically saying that when you look at 6-7%, this is James Bullard, it seems to be restrictive. Onto the UK as well, the Chancellor, Jeremy Hunt, outlined his autumn budget to Parliament yesterday. In that address, he confirmed that the economy will slow next year.
They also judged that the UK, like other countries, is now in recession. Overall this year, the economy is still forecast to grow by 4.2%. GDP then falls in 2023 by 1.4%.
Let's get back to Ben. Ben, is there anything in UK assets that look undervalued right now?
Well, depending on your time horizon, most of it, I would say. There's still some cheapness in UK equities that, for the long-term investor, has appeal. But of course, in the short term, as we're also acutely aware, the ongoing trend is of sort of the consumer squeeze, crisis in sort of living standards, that makes sort of the domestic UK economic story really challenging, which would lean against taking a really bold view on UK equities at this moment. But of course, there is cheapness there. So on that basis, relatively sort of neutral, on the fence view, I'm afraid.
Ben, presumably that valuation call around UK, it takes you to the mega caps, the FTSE 100, or are you starting to look at FTSE 250? Surely that's not a proposition at this point.
Well, I mean, I would say that that across the board there is
really
opportunity there. Yeah, for sure. I mean, you know, it doesn't take me or indeed Jeremy Hunt to tell you that the UK economy's got a challenge ahead of itself. But the market has, you know, as it does, will move ahead of that. But you know, investors have just got to be prepared for volatility in that asset class. But certainly over a longer term horizon, you know, the pound is cheap, and I think on a relative basis that's good news for UK assets. But of course, you know, the dollar story remains sort of quite robust at the moment, given the growth challenges and geopolitical challenges we have.
What's the value proposition for a FTSE 250 company that actually has, you know, very little outward selling points and is dealing with all the challenges, including high cost of living, mortgages going up, but also not finding the right staff?
Well, I mean, it's not a really easy story to tell. I mean, this is, you know, a valuation angle rather than one that I can say, you know, there is a consumer recovery. We're on the cusp of a consumer recovery story. You know, the markets, I would just say, are relatively well briefed on the idea that the UK consumer is facing a challenging period.
Okay, the valuation call there from Ben Gutteridge. I know you're bullish the pound as well. It's playing out, at least in the session today. The pound currently up about 0.4% at 119. Ben Gutteridge, thank you very much indeed. Asset Management Director of Model Portfolio Services at Invesco EMEA. Okay, let's get the Bloomberg First Word News now with Laura Wright. Laura.
Thanks, Tom. North Korea has fired a suspected intercontinental ballistic missile a day after warning the US over continued military drills with allies in the region. Japanese Prime Minister Fumio Kishida says the missile probably landed inside the country's exclusive economic zone. In an effort to break deadlocked climate talks in Egypt, the European Union has proposed a loss and damage finance facility for the most vulnerable countries. EU climate chief Frans Timmermans put forward the offer in exchange for a pledge to reduce use of oil, gas and coal. It comes after days of little progress at COP27 talks in Sharm el-Sheikh. Nancy Pelosi is stepping down as the Democrats' leader in the U.S. House of Representatives. The decision comes after Republicans secured a slim majority in the chamber in last week's midterm elections. 82-year-old Pelosi has led House Democrats for almost 20 years under 4 presidents and was the first woman to serve as Speaker. Japan's inflation has hit a 40-year high, with consumer prices excluding fresh food climbing 3.6% in the year to October. Core inflation has now exceeded the central bank's 2% price target for 7 straight months. The BOJ continues to maintain stimulus is needed to secure stable price growth. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom Francine.
Laura, thanks so much. Laura Wright in London. Now, coming up, an ultimatum from Elon Musk is said to have resulted in an exodus of employees, putting the company's operations at risk. We'll have plenty more on that story next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci is really teetering on the brink at this stage.
multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg. Names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
Welcome back to The Open, everyone. 13 minutes into the European trading day, and for the moment, we're holding strong, maybe strongish. I'm overdoing it maybe for a Friday morning. Happy Friday, everyone. European stocks gaining some 0.4%. Again, it's all about what Fed officials are telling us and the pace of change in terms of inflation forecasts.
Okay, let's get to what is consistently one of Francine's favorite stories, which is, of course, the travails of Twitter. And earlier this week, Elon Musk issued an ultimatum to Twitter employees. He said, you either commit to the company's new, and I'm quoting, hardcore work environment or leave. Well, the deadline has now passed, and sources tell Bloomberg that so many more workers have chosen to go than he expected that it's in fact leading to major complications. Joining us now is Bloomberg opinion columnist Tim Colpin. Tim, what is the state of Twitter at this point? Is this company even going to survive?
It may survive the weekend, it may not. You know what, if you're on Twitter and you see the salute emoji, that is the emoji that many Twitter employees are giving out on the internal Slack and on Twitter itself, saying, I'm out of here. That's exactly what's happening. He gave them an ultimatum, and it probably didn't go the way that Elon Musk wanted. To be fair, there will still be people sticking around, including many people who are at Twitter because they have an H-1B visa or some kind of visa to keep them in the country. So those who rely on Twitter for their employment visa will probably be sticking around. But, you know, Twitter is going to hire people. Elon Musk is going out there and rehiring some of the people he's fired or who've quit. He'll probably go and try and get some new talent as well. But in the meantime, they've got to really keep it together with kind of chewing gum and rubber bands until he can get a new staff up and running.
So, Tim, how can he actually do that? I mean, could he suspend Twitter until they find new staff, or is Twitter a dangerous place in the meantime?
Well, in theory, he could suspend it. And it's not like, you know, there's a whole lot of people out the back cycling on a kind of a pedal wheel, you know, churning electricity to keep it going. There is servers that run it, but as long as they don't do any major software updates and there's no major changes to software in terms of any of the other parts of the puzzle they interact with, such as other software vendors, cloud service vendors, network vendors, as long as there's no changes in the software stack itself, there's no real reason why it shouldn't keep going on forever. But software doesn't stay still. Things do change. We have heard that Musk himself has declared that there shall be no changes to the production code, the stuff that actually runs live on a server. And if that's the case, that would certainly mitigate any chances of failure or collapse. But, you know, at some point in time, things will change, and maybe it'll be a week, maybe it'll be a few weeks, and the staff who are left there will be the ones trying to manage that infrastructure to make sure it does keep ticking over.
Yeah, with gum and sticky tape, as you've suggested. Tim, there's the internal dynamics and everything that's playing out within Twitter, and then there's the external dynamics and the potential probe into Musk's purchase of this business. Do we know anything else about that? What kind of challenge and headwind that could provide for Musk going forward?
Well, this idea that there's some kind of national security implication has been floating around a while, but, you know, until something serious or formal has been, you know, launched, it is a little bit hearsay. There's reasons to believe that there might be some national security concerns, but if you're going to look into Twitter, there's so many other deals to look into as well. So I think we really need to wait and see and not get too excited about that at this stage.
Thank you so much, Tim Colpin there joining us. You can read more from Tim and the opinion team by typing OPIN, go on Bloomberg Terminal. I was gently scolded for not reading all of his columns because he also goes through some of the social media that could replace Twitter. Coming up, the UK Chancellor delivered the budget yesterday. Let's now find out what his opposite number thinks. We speak to the Shadow Chancellor, Rachel Reeves. That's coming up next, and this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. 20 minutes into the European trading day. Also, happy Friday, everyone. European stocks for the moment gaining some 0.3%. We're also looking at Treasury yields. I know they're pretty much steady after the previous day's jump when we heard from Jim Bullard talk about inflation and a lot more policymakers saying they should still increase interest rates to at least 5 to 5.25%, even though inflation may be peaking, Tom.
Yeah, we'll check in on a couple of individual corporate stories. We had that autumn statement, of course, from the UK Chancellor yesterday. There was some movement around the energy companies because key to that was an announcement that there would indeed be a temporary 45% windfall tax on that space. Today, though, some of these players are gaining. The take is that there's a bit of relief around the details of this announcement. Now, at least they have surety and some kind of certainty around what is coming in terms of those tax increases. So you get the likes of Centrica then up 3.5% on the back of that. Another company we're looking at, Teleperformance, this, of course, a French company, gaining, as you can see, 4.8%. Now, the news here is that they have pulled out of the content moderation part of their business, which is seen as a positive by analysts. And just briefly, SAP, of course, the German software company, currently down 2%, has been downgraded by Jefferies. Francine.
Now, this is, of course, the interview of the day. The UK Chancellor yesterday, Jeremy Hunt, has laid bare a bleak new reality for the UK economy, one plagued by weak growth and rising taxes for years to come. Here's what he had to say about the outlook.
They also judge that the UK, like other countries, is now in recession. Overall this year, the economy is still forecast to grow by 4.2%. GDP then falls in 2023 by 1.4%.
Well, joining us now is the UK Shadow Chancellor of the Exchequer, Labour's Rachel Reeves. Thank you so much for joining us, Shadow Chancellor. When you look at what was announced yesterday from Jeremy Hunt, when you look at some of the broader church or certainly taxation on broader shoulders, is this a Labour policy?
Well, first of all, I'm very concerned about the outlook for the UK economy, for unemployment, economic growth, and also inflation, incredibly difficult times for families and also for businesses. In terms of the choices that were made yesterday, more could have been done to make these fair choices and to ease some of that pressure on ordinary working people. So, for example, I said that if you make Britain your home, you should pay your taxes here, and Labour would have abolished the non-dom tax status. Additionally, the reduction in the bank surcharge at a time when banks are making big profits because of the rises in interest rates, that was not the right priority in yesterday's autumn statement. And if you made different choices, then you could have eased some of that pressure that is seeing ordinary incomes being eroded twice now, first by double-digit inflation and second by the stealth taxes that the Chancellor introduced on those incomes yesterday.
Okay, so Rachel, those are some of the things, the changes that maybe you would have made. Presumably, though, you do support the windfall tax on the energy sector, you support the additional funding for the NHS, you support the additional funding for education, and presumably you support the higher tax rate for higher earners.
Well, if you look at the windfall tax, for example, you'll know that Labour have been advocating that for a year now. I first called for it in January. But there are still windfalls of war that are being left on the table. The investment allowances, for example, mean that some of the big energy giants are still not paying any windfall tax. And that is wrong, because every pound left on the table that could have been got through a windfall tax on the energy giants is a pound more that people are paying on their gas and electricity bills. So we would make that system fairer to bring in more money to help people with their bills over the next few months and potentially years. But just on the energy issue, you know, the short-term sticking plaster approach of this government, it just isn't good enough. We should be insulating people's homes. We could have insulated 2 million in the last year, and that would take up to £1,000 off people's bills, not just for 1 year, but permanently. We need to be investing here in Britain in the cheapest form of energy, and that is renewables, with floating offshore wind, with the moratorium on onshore wind being lifted, with investment in green hydrogen. There are big opportunities for Britain in these industries of the future, and the government aren't seizing them.
Shadow Chancellor, what would you do about mortgage rates?
Well, the big challenge on mortgage rates came when the last Prime Minister and Chancellor introduced their mini-budget just 2 months ago. And that created, as you well know, wild volatility in financial markets, with government borrowing costs rising and borrowing costs for ordinary families rising, and businesses too. And I think the Resolution Foundation have said that the permanent damage done by that has left a £30 billion black hole in the government finances, and mortgage rates are still not back to where they were before that mini budget. So that's why Keir Starmer and me have said that economic stability and security are the #1 priorities. It's why I've set out a set of fiscal rules that an incoming Labour government would stick with.
Would you keep the stamp duty cut that Jeremy Hunt is ending?
No, we wouldn't have introduced it in the first place. And I've said that previously. That, again, is money that could be used to help ordinary people who are seeing their day-to-day taxes increase. So that was one of the few measures that the Chancellor actually kept from Liz Truss's and Kwasi Kwarteng's mini-budget. And I think that was a mistake.
Some of the credibility that was clearly lost after the Liz Truss budget has been restored, at least partially within the markets. Part of that is down to the spending cuts that have been committed to by the current government. A lot of those spending cuts being pushed back into the second half of their term, or at least being pushed back potentially post the election. Would you commit to those spending cuts?
Well, first of all, I thought your way you introduced that was interesting. You know, they've partially brought back some of their credibility. What a mess this country is in. We've had 12 years of Conservative government, 12 weeks of utter chaos, and it is ordinary working people and businesses that are paying the price for that volatility, that chaos that we've seen in recent weeks. And at the next election, people will be asking themselves, are me and my family better off with a Conservative government? And the answer will be no. In terms of where we are at the next election, I've already set out to you, and in the response to the statement yesterday, some of the different choices that Labour would make, for example, on tax. But I'd also say this, in the last year, as Shadow Chancellor, I've responded now to 4 budgets. And by the next election, we may have another 4. We may have another 8. We just don't know. I've said that because of the mess that the Tories have made, Labour might not be able to do everything it wants as quickly as possible. And we have a set of fiscal rules that an incoming Labour government would abide to. But I'm not going to set out our plans for the next election and the next manifesto right now, because the path of the UK economy is so uncertain right now that it would potentially be out of date before before I could write it all down.
Well, one boost for the UK economy would be rejoining the customs union and the single market. Will you start to advocate for that?
No, because I want to be Chancellor of the Exchequer rather than Shadow Chancellor, and the country voted to leave the European Union. The issue now is to fix the mess that the government have made of our trading relationship with Europe. And there are a number of things that government could do to improve that. We need a veterinary deal to reduce some of those delays at the border, not just for agricultural companies, but for all businesses. Services are our biggest export, and yet there was no deal for the service sector in the Brexit agreement that the government secured. So we would look to get the mutual recognition of professional qualifications, UK participation in the Horizon scheme, reducing the bureaucracy for our fantastic creative industries that at the moment find it difficult to tour across Europe. Those are just some of the practical changes that would improve trade between us and our nearest neighbours and trading partners, and just a whole different approach where we see other European countries as friends and allies and partners to improve the relationship rather than constantly trying to find division, and that would see a boost to our economy, our competitiveness and our trade with the European countries.
Can you quantify for us how much Brexit is actually weighing on the UK economy?
Well, I was an economist in a former life, but I haven't done my own forecast. But I've looked at the Office for Budget Responsibility and other people's forecasts that show that the Brexit deal that the government has secured has cost our economy dearly. And that's why we want to fix some of those holes in that Brexit mess to improve trading relations, to make our economy more competitive and ensure that British businesses can't just survive, which is a challenge for many at the moment, but actually thrive in the economy that we are in today.
Okay, Rachel Reeves, we appreciate your time. Thank you very much indeed. UK Shadow Chancellor of the Exchequer with that response to the autumn statement. Let's check in on these markets then. I'll start with the FTSE 100, given that conversation. You're currently seeing very modest gains of 0.2%. Again, within the energy space, you've seen a bit of relief on the assessment around that 45% windfall tax from the Chancellor. So that's a 0.3% gain across the FTSE 100. More broadly, across the European stocks benchmark, you're seeing gains of 0.5%. Stateside, though, S&P E-minis currently down 0.1%. Nasdaq futures in similar territory. Francine, we've been discussing this, of course, the conversation, at least the pushback from Fed officials, James Bullard, suggesting that you have to get to at least 5 to 5.25% in terms of the terminal rate. That pushback from the Fed officials around some of the sentiment within these markets that maybe you're close to a pause or a pivot.
Yeah, and we've seen this actually over the last 12 months, right? The fact that the markets believe that when you reach peak inflation, then interest rate hikes will ease off. And then you hear from Fed officials and frankly also former governors of, maybe the Bank of England or even former ECBs and saying, even if you want to reach your target, it still means aggressive cuts. And this is why you have this dichotomy between what, the speeches and the Fed officials are saying and what the markets are seeing.
Indeed, and when it comes to the ECB, there is an expectation in our own reporting that you're going to get 50 basis points, so a step down from 75 basis points to 50 basis points later this month. We are waiting for Madame Lagarde, of course, of the ECB, who's going to be giving a speech any moment now. I'll check on the euro briefly because the single currency is currently down 0.1%, currently trading at 1.03. The pound, by the way, gaining 0.3% at 1.18. We'll keep across some of the other asset classes as well. In terms of your treasuries and the yield curve, after the run-up of yields yesterday, again, tying into that commentary from Fed officials, you're seeing yields up just around 2 basis points at the front end, 4.47 on your US 2-year. The 10-year, 3.78. That's a move higher by 2 basis points. Briefly looking at gilts as well. Yields up 5 basis points at the front end, 3.16. Again, investors still digesting the fallout of the autumn statement from the Chancellor. The 10-year gilt, 3.23. That's a move higher by 3 basis points. Francine.
Now, some of the other things we're watching. Yesterday in the U.S., we had some fresh data showing weekly jobless claims, for example, came in below the forecast, further underscoring the strength of the labor market. So I think if you look at country by country, certainly region by region, it's very different. If you're sitting in the U.S., I'm looking at U.S. mortgage rates, and they were posting their biggest weekly decline since 1981. Again, that briefly improved sentiment, but when you look at where we are, you just need to think about affordability, and we were just having a great conversation there with the Shadow Chancellor of the Exchequer, Rachel Reeves, about what she'd be doing with mortgage rates. And also, it was interesting to hear her, say about Brexit, almost saying, well, look, we can't reverse this because I want to be chancellor. And the fact that it often feels like, Brexit is a bad word that can't be uttered if you want to be elected.
The conspiracy of silence, as I think the Financial Times put it, but it was a really fascinating response, and it points to that determination, of course, to get into power, but the risks around, as they say it, within the Labour Party of addressing that issue, even as the polls suggest that people are increasingly disenchanted with the fallout of Brexit. Now, we are getting some lines from Madame Lagarde of the ECB saying that the risk of recession has increased, Francine. Recession unlikely to quell inflation significantly.
So we'll hear from Madame Lagarde very shortly, but first, let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. North Korea has fired a suspected intercontinental ballistic missile a day after warning the US over continued military drills with allies in the region. Japanese Prime Minister Fumio Kishida says the missile probably landed inside the country's exclusive economic zone. In an effort to break deadlocked climate talks in Egypt, the European Union has proposed a loss and damage finance facility for the most vulnerable countries. EU climate chief Frans Timmermans put forward the offer in exchange for a pledge to reduce the use of oil, gas and coal. It comes after days of little progress at COP27 talks in Sharm el-Sheikh. The new CEO of FTX has laid out a list of allegations against the company's former leadership, slamming them for non-existent oversight and misuse of client funds. In a sworn declaration submitted to the bankruptcy court, former Enron liquidator John J. Ray says he's never seen such a complete failure of corporate controls. He also says advisors have located only a fraction of the digital assets they hope to recover. Twitter has closed its offices until Monday after Elon Musk gave staff an ultimatum to either commit to working long hours at high intensity or to leave. Sources say many more workers declined to sign Musk's pledge than he expected, potentially putting Twitter's operations at risk. A memo seen by Bloomberg also urges staff to refrain from discussing confidential information on social media or in the press. Nancy Pelosi is stepping down as the Democrats' leader in the U.S. House of Representatives. The decision comes after Republicans secured a slim majority in the chamber in last week's midterm elections. 82-year-old Pelosi has led House Democrats for almost 20 years under 4 presidents and was the first woman to serve as Speaker. Japan's inflation has hit a 40-year high, with consumer prices excluding fresh food climbing 3.6% in the year to October. Core inflation has now exceeded the central bank's 2% price target for 7 straight months. The BOJ continues to maintain stimulus is needed to secure stable price growth. BHP has made a second bid for OZ Minerals as the Australian mining giant looks to expand its copper assets. The offer comes 3 months after OZ rejected BHP's initial bid, which valued the company at $5.6 billion. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom Francine.
Laura, thank you so much. Laura Wright here in London. Coming up, we'll be hearing from the ECB President, Christine Lagarde. We know that we were giving an advance copy, actually, of her speech. And so then she'll take a Q&A. So it is worth listening in. But she's saying cutting public investment could harm the economies. And she says the risk of a recession has also increased.
Yeah, currently euro dollar, you're looking at 1.03 on euro dollar. That's just a drop of about 0.1%. Just continuing to recap some of these lines then from Madame Lagarde. And we can come to her live just in the next few seconds, saying that the flexible reinvestment of the PEP scheme will stay in place. The balance sheet does need to be normalized, she says, in a measured way. Recession is unlikely to quell inflation significantly. That, of course, after suggesting and saying that recession risks have increased. Madame Lagarde saying that withdrawing accommodation may not be enough for rates. 103 on euro dollar, just down 0.1%. I'm going to check in the bunds as well, because you've got to sell off more broadly across these bond markets. German bunds, you're seeing a move up just by 3 basis points. BTPs on the 10-year, 398. That's a move higher by 5 basis points. All right, we're going to come to a break now and come back, hopefully, with Madame Lagarde of the ECB. Stay with us. This is Bloomberg. you are in for a treat. We're not going to break. We're going to go straight to the ECB President, Madame Lagarde. Let's listen in.
Cher Christian, dear Mr. Trichet, cher Jean-Claude, dear Mrs. Fust, dear Mr. Scholz, and to all of you ladies and gentlemen, good morning. Thank you to the EBC for bringing us back together. I'm sure you've heard that many times, how much more pleasant it is to be together. I'll share with you a comment that I heard a couple of days ago in a similar circumstance, where, just like with us at the EBC, thank you for inviting me, we had not met physically for 3 years. And that person very kindly looked at me and said, "You are older, but you look better." So I turn it over to you. We are all a bit older, but we are looking a lot better than on those awful screens. So it is my pleasure to speak to you this morning, and I want to thank you very much, Christian, for this kind introduction and for the very clear speech that you delivered with multiple messages that I'm sure many of us will, in the course of the day, continue to develop. But it is really a pleasure to be here. When the former British Prime Minister Harold Macmillan was asked what the greatest challenge was for a statesman, he's known to have said, "Events, dear boys, events." And indeed, as policymakers, we are constantly faced with unpredictable events and shocks. But what makes the situation we face today especially challenging is that we're not just facing a sequence of incredible shocks, ill-fated events, I would call them. The pandemic, the energy crisis, Russia's unjustifiable invasion of Ukraine. Thank you, Madam Deputy Mayor, for your words on that topic. And of course, high inflation. But as a result of that, the environment that we are operating in is changing profoundly. Some of the major trends that characterize the past few decades are shifting or even reversing. In particular, we can no longer assume, at least in the near future, that global supply will gradually expand or that global demand will act as a shock absorber. And this has implications for the focus of macroeconomic policy in the years to come. Today, what I will try to do is argue that 3 themes will matter. 1, ensuring price stability as the different shocks play out. 2, lifting constraints on growth in the areas where they have emerged. And 3, safeguarding a resilient financial sector which can support the transitions we will face. I will spend a bit more time on the first of these 3 items, as you can imagine, because for the ECB, displaying our commitment to our mandate is vital to ensure that inflation expectations remain anchored while inflation is high. We are committed to bringing inflation back down to our medium-term target, and we will take all the necessary measures to do that, rest assured. But in order to overcome the ongoing challenges, other public and private players will need to help accelerate the transition to that greener, more digital, more productive economy that we all aspire to. So let's have a quick look at the changing environment, which has been alluded to by Madam Deputy Mayor and by Christian Sewing. But I'll focus on a couple of them, which matter for us. One, probably of the most important macroeconomic stories of the past 30 years has been the rising interconnectedness of the global economy and its implications for global supply and global demand. China's entry in the global economy, particularly as of its joining the WTO, led to a massive increase in global labor supply. Global supply chains became more unbundled and efficient, lowering inventory levels and reducing costs. And energy markets changed fundamentally as well as new producers emerged, notably shale oil and gas, particularly in the United States, making global oil and gas supply significantly more elastic. At the same time, globalization allowed growth to become less beholden to swings in domestic demand, as countries could rotate demand towards the rest of the world when faced with domestic slumps. This proved especially valuable in Europe in the wake of the sovereign debt crisis. Between 2010 and 2014, external demand as a share of euro area GDP more than doubled. When it was tough at home, we looked elsewhere, and it worked. These two forces meant that inflation became unusually low and stable. A floor under demand meant that major busts in domestic demand resulted in less volatile inflation. And elastic supply meant that major booms, such as the one we saw before the Great Financial Crisis, did not produce serious inflationary pressures. Now we are facing a new environment. New supply constraints have arisen in the global economy owing to supply chain disruptions, zero COVID policies, still surviving in some corners, energy production cuts, and the unacceptable Russia's invasion of Ukraine. And in this context, swings in demand caused by the closing and reopening of the economy have hit a wall. Rather than quantities increasing to match demand, as we had seen before, prices have surged instead. And that is a key reason why, alongside rising energy prices, inflation has returned so fiercely. We know that some of these constraints will fade over time. We are already beginning to see, for example, shipping costs declining, delivery times shortening. But other changes may well be more persistent. The shocks triggered by the pandemic and the war are creating what I have called a new global map of economic relationships. And in this environment, it is uncertain whether a seamless expansion of supply will continue and how global demand will be affected. And I would like to focus on two shifts that are characteristics of this new global map. There are others, but I want to focus on these two. The first one is what I call from efficiency to security of global supply chain. And the second is from dependence to diversification, and it will not surprise that I would focus on energy. From efficiency to security. This is reflected in the new industrial policy that in the very recent years have prioritized geopolitical goals over efficiency constraints. Many advanced economies are coming to see their past deindustrialization as vulnerability, leading to a push to reshore, close shore, friendshore, however you name it, those industries that are regarded as strategic. And the definition of strategic has had multiple dimensions, as we can remember from the COVID crisis. This is likely to increase cost and affect production while supply chains are adjusting. At the same time, this shift could cast doubt on China's role as a source of global demand, depressing investment and equity values for European firms. If you look at the recent policy choices in China, choices to focus more on domestic demand, coupled with the US export controls on semiconductors in particular, but not only, and trade restrictions on key technologies owing to cyber risks. This could definitely affect China's place in the global economy. The second shift that I want to also mention is this move from dependency to diversification, notably in the field of energy. Europe is experiencing painfully the cost of overdependence on a single supplier, an unreliable one. And the process of diversifying our energy supply will have ramifications for years to come. For instance, we may have to pay a premium for some time to attract uncontracted liquefied natural gas to replace Russian gas. In the longer term, the need to diversify is also likely to accelerate the green transition in Europe, and massive investment in renewables will boost both energy supply and aggregate demand over time. But during the transition phase, we face uncertain effects on both sides of the economy. We could see lower investment in oil and gas production, putting upward pressure on fossil fuel prices, while demand for those fuel products still remains high. That's the principle of the transition. At the same time, writing off existing carbon-intensive capital might produce a negative effect on wealth and lower aggregate demand. So as a result, all of the main forces that drove expanding supply over the past decades and cushioned global demand, the role of China, supply chains, abundant and cheap energy, are changing. And the net effect on aggregate supply and aggregate demand will only become clear in time. In this context, the three themes that I have mentioned at the opening of my remarks are crucial if they are developed consistently and together. First one, ensuring price stability as the different shocks play out. Second, lifting constraints on growth in the areas where they have emerged. And three, safeguarding the resilient financial sector which can support the transition we will face. I have to tell you, each of these three themes would warrant an extra speech. So you'll re-invite me. Maybe I could replace Christian. No, sorry. I didn't mean to say that. So let me focus on the first one, which is ensuring price stability. For monetary policy, this changing environment creates considerable challenges. You've mentioned that very kindly. I was attending a wonderful dinner last night, and most people I spoke to said, we really don't want to be in your shoes. It gives a measure of the challenge that we are facing. When nobody wants to take your job, there's something. Inflation in the euro area is far too high. It has reached double digits in October for the first time since the start of the monetary union. And with inflation likely to remain high for an extended period, we need to monitor the evolution of inflation expectations very carefully. Additionally, although recent data on GDP growth have surprised on the upside, yes, yet the risk of recession has increased. But historical experience suggests that a recession is unlikely to bring down inflation significantly, at least in the short run. So in this setting, displaying commitment to our mandate is vital to ensure that inflation expectations remain anchored and that second-round effects do not take hold. And that is why we have been raising rates at the fastest pace ever, by already 200 basis points in our last 3 policy meetings. These rate increases help us to withdraw support for demand more quickly. And they send a clear signal to the public of our determination to bring down inflation, which will help anchor expectations. Yes, we expect to raise rates further. And withdrawing accommodation may not be enough. Ultimately, we will raise rates to levels that bring inflation back down to our medium-term target in a timely manner. As I explained recently, how far we need to go, how fast, will be determined by the inflation outlook. This is forward-looking and incorporates all the different forces that we are facing: the outlook for the economy, the persistence of the shocks, the reaction of wages and inflation expectations, as well as the proper transmission of our policy stance. Interest rates are and will remain the main tool for adjusting our policy stance. But we also need to normalize our other policy tools and so reinforce the impulse from our rate policy. And that is why we recently decided to amend the terms and conditions of our targeted longer-term refinancing operations. The targeted longer-term refinancing operations addressed the need for significant stimulus during the pandemic, strengthening the transmission of rates to the economy via banks. But now the environment has completely changed, and we need to ensure that the lower cost of funding that TLTRO created for banks does not impede monetary transmission when policy normalization is required. Similarly, large-scale asset purchases were necessary to expand the policy stance when interest rates were close to the lower bound. But in the current environment, and acknowledging that interest rates remain the most effective tool for shaping our policy stance, it is appropriate that the balance sheet of the central bank is normalized in a measured and predictable way. In December, we will lay out the key principles in sufficient details for reducing the bond holdings in our asset purchase program portfolio. In parallel, our tools for preserving the orderly transmission of our monetary policy, notably the flexible reinvestment of the pandemic emergency purchase program and the new transmission protection instrument, will remain in place and available. Turning now to the lifting work that needs to be done. Monetary policy will ensure a timely return of inflation to our medium-term target, but the economic outlook will also depend on the alignment between monetary policy actors and other actors. In the short term, the stance of fiscal policy is important. And in this current environment of high inflation, fiscal policy needs to be temporary, targeted, and tailored. That's my triple T for you. It should be temporary so that it does not push up demand too much over the medium term. Needs to be targeted so that the size of the fiscal impulse is limited and benefits focused on those who need it most. And it should be tailored so that it does not suppress the price signal that is needed in order to reduce our energy consumption. Looking further ahead, while monetary policy can steer demand, it cannot remove existing constraints on economic growth. Other policy areas will need to act. Removing those constraints will not only rebuild supply that has been impaired by the recent shocks, it will also over time strengthen domestic demand in a world where external demand is becoming less predictable. The drive to speed up three key transitions will determine our future. First, towards cleaner energy. Second, greater economic security, and third, a more digital and productive economy. First, we urgently need to step up investment in clean energy to counterbalance lower investment in fossil fuels and falling Russian supply. And I would suggest, by the way, that some European countries are reasonably well positioned in that respect. But we need to beef up our games. This is not only about increasing domestic energy production, but also about innovation, about developing new technologies that will help us solve the intermittency and storage challenges of renewable energies. And in the short term, reforming Europe's energy markets will be critical and is urgent so as to avoid recurring volatility in energy prices while we diversify away from Russian gas. Second, I agree with you. Europe's strategic autonomy agenda will be pivotal in making growth more resilient to the changing nature of globalization. In a world fragmenting into blocks, it will allow us to retain access to critical technologies and resources, both through reshoring strategic industries and securing strategic alliances that are well selected and of which cost and benefits are weighted. And that will in turn underpin our energy transition, which is highly resource intensive. Let's take the example of the electric vehicle, which are just growing significantly at the moment. They use around 6 times more minerals than conventional cars. Some of them we have, many of them we don't. Hence the importance of operating strategically and selecting our alliances with that purpose. Third, to cope with shrinking global labor supply, as well, unfortunately, as our own aging societies, we will have to produce more with less. That is, addressing Europe's chronically low productivity growth by boosting our rate of innovation. This will require the rapid digitalization of the economy in terms of skills and technologies. Consider that only around half of EU firms innovated or adopted new technologies in 2021, compared with close to 2/3 in the United States. And yes, the Capital Market Union is one way to address those issues, because to innovate, you clearly need financing and multiple sources of it. Collectively, these transitions will require significant investment. The European Commission has estimated that climate-related investment needs alone will amount to almost €500 billion on average per year until 2030. And more than 100 billion per year will be needed to close the digital gap and upskill labor forces and manage the digital transition. So, let's not forget, this was a few months ago, but it is still there and being used and drawn upon. The €750 billion Next Generation EU Fund, with its focus on green and digital spending, is a good tool for ensuring that investment flows where it is needed over the next few years. But it will ultimately need to be matched and exceeded by higher investment from other sources. Obviously from the private sector, but also most likely by national governments that will play a different role. According to one estimate, the public sector will need to fund between 1/4 and 1/5 of climate-related investment. This means that when the time comes for national government to consolidate their fiscal policies, because that time will come after the TTT, it will make a difference whether they do so by reducing transfers and public consumption and raising taxes, or by cutting public investment. If they opt for the latter method, cutting investment, as they did after the great financial crisis, there is a risk that supply will not be rebuilt and constraint of growth will continue to bind. And I'll come to my third and final theme, which you have described broadly and which I will just brush upon. Because to support all these transitions, we need a resilient financial sector. As you've indicated, the situation for banks has changed dramatically since the great financial crisis. You were there, I was there. I was finance minister for France at the time. And we all saw or lived through those dramas. Banks were indeed part of the problem. During the pandemic, which was an unparalleled crisis, the banks were at the heart of the solution. Not least because thanks to more solid and more rigorous regulation, they had stronger capital and liquidity positions. Now, we need banks that continue being part of the solution. So undermining the solid foundation we have built together, it has taken a while, let's face it, we are there, would not help bring this about. We are facing a fast-changing world characterized by multiple shocks and profound uncertainty. And in this setting, over-diluting regulation would leave banks more exposed to shocks and less able to support the transitions on which our future growth will depend. And that would neither be in the interest of the sector, which ultimately would be less profitable, nor of the economy, which would lack the financing it needs and would find alternative sources. Because the nature of financial intermediation is changing, and we must ensure that this contributes to the sector resilience, that it doesn't threaten the sector resilience. So let me mention two changes that we see and where somehow we can be effective. The first one is the digitalization of payments, which is spreading rapidly, not in all countries of Europe, but certainly in a large number of them. That can create opportunities, and I know that some of you are seizing on those opportunities. But it could also pose new types of risks as new players, quite novice in the business, and new products, sometimes uncertain, enter the market. Central banks are responding by advancing the development of central bank digital currencies. These currencies could give banks a tool to offer improved products and services built on the stable foundations of digital public money. Banks will have a role to play in that digital transformation and can seize it. Not to cope with transformation, as is the theme of the day, but to thrive on those transformations. Second, the role of non-bank finance is growing and is a worry, let's face it, not just here in Europe, on both sides of the Atlantic. Its share of overall credit has been rising from 15% in 2009 to 26% nowadays. Now, this has to be reflected, if only for level playing field reasons, and security and protection, in a stronger macroprudential framework for non-banks. Specifically, we need a framework that focuses on building resilience ex ante rather than relying on ex post measures. There are many other things that I could debate and discuss for you, but my time is counted, so I will conclude at this point. We are indeed entering a new environment where the forces that created a sustained expansion of global supply and allowed global demand to act as a shock absorber are changing in front of our eyes, and probably profoundly. The effects of this shift are uncertain, but the duty of monetary policy is not. The ECB will ensure that a phase of high inflation does not feed into inflation expectations, allowing too high inflation to become entrenched. We have acted decisively, raising rates by 200 basis points, and we expect to raise rates further to the levels needed to ensure that inflation returns to our 2% medium-term target in a timely manner. But if we want to rebuild our supply capacity and strengthen domestic sources of growth, other policy areas need to refocus. Most importantly, they need to direct investment towards the transitions that will define our future, and the financial sector needs to be able to actively support these transitions. We have joint interest. Consistency between public policy areas remains important in a post-pandemic world. If we respond separately to today's challenges, we risk standing in each other's way. But if we act together, we can rise to those challenges and ensure that our objectives are met and that we seize the opportunity rather than lament about the risks. So maybe for another theme of the EBC for another year, you could change coping with thriving, because we can do it. Thank you.
ECB President Christine Lagarde speaking at the European Banking Congress, of course, saying that interest rates, she believes, may be needed to be lifted to levels that then restrict economic expansion in order to drive down inflation that's rocketed to more than 5 times the official target. Now let's get straight to Maria Tadeo, who joins us from the event with a guest. Hi, Maria.
Yes, Francine, good morning. And we're now joined by Jeremy Settelmeyer, who is the new director at Bruegel. And you come in handy because this was a very long speech, but also a lot of details. For you, when you look at the whole thing overall, what's the key takeaway?
Well, I thought she struck a very nice balance between, a hawkish tone, but on the other hand, keeping her options open and basically being data dependent.
For December, and to me, there's 2 things going into December that were important. She said, "Don't be fooled by the data. The idea that a recession will materialize is actually increased." Is that something that you share? And also, did you get a sense that essentially what she says is, we're going to continue to hike even in a recession? It's needed.
Yeah, that point that you just mentioned is what made it a hawkish speech. So she wanted it to be clear to the listener that just because the ECB thinks that a recession could well happen and that the recent data does not contradict that expectation, it doesn't mean that it will not tighten.
Despite the risks, because some say you will suffocate this economy. You're hiking too aggressively in a recession. Is that something that you think, however, is warranted at this point?
Well, she was very frank in saying, look, even a recession may not bring down inflation by itself, right? That's a pretty hawkish statement. On the other hand, she was also very careful to say, we will reduce inflation to our medium-term target in a timely way, right? So the timely thing is what gives her the wiggle room.
And I wonder, of course, a wiggle room because there's a decision to made around the corner. And the question, I'm going to put you in the spot, is it 50 basis points? Is it 75 basis points? It wasn't clear today, but in your view, which way is it going to be?
I think they haven't made up their mind yet.
They haven't?
I don't think. At least from this speech, you could not tell, but I would say she was erring a little bit on the hawkish side.
Erring on the hawkish. What about the doves here who say it's 200 basis points, it's already a lot, let's just wait and see the real implications of this? Is that a case to be contemplated? It's a lot very fast.
I understand the doves. I'm a dove myself, but I think that at this point, they actually want to see evidence that it's working before adopting that position.
And can I ask about QT? Because she mentioned it, and she talked about a detailed plan. When we talk about a detailed QT plan in December, so that is around the corner, in your view, what does it imply? What does it mean?
I think what it meant is we'll give all the information to markets so that they can predict at what pace we will reduce the balance sheet.
And a timeline, therefore, dates.
That is not clear to me. It could be data dependent too. So we will see that in December.
And it's a very difficult question that I'm going to put to you, but if you get a detailed plan on QT, a 75 basis points hike in December, is that not going to lead to a big market tantrum? Like this bank has gone way too hawkish very fast. Do the two at the same time, that's potentially risky for markets.
I think it all depends on the content of that detailed plan. I think that the 75% alone will not lead to a tantrum.
Okay, and just a final question. She repeated many times, we have a goal and a mandate, that is to bring down inflation. Clearly, they've failed this year. A lot of people tell you they also failed in their assessment, that this was not a one-off, that this was entrenched inflation. I wonder, it's a tough question too, but has she lost some credibility, or the institution itself?
Clearly, they have lost a little bit of credibility, which is why they are, if anything, erring on the hawkish side now.
But when you say they have lost some credibility, is it because of the way they've acted? Is it because of perhaps some of the changes, big changes at times in the diagnosis of the situation, or just because of the policy combination itself? Some argue that they lost a big window to hike at the start of the year.
I agree with that. So I think that they basically gave themselves a rather confusing instruction in December of last year, which essentially mixed a time-bound pace of hiking with data dependency. And then they were caught up when these two things produce a contradiction, and as a result, even though the data argued for much faster tightening, they stuck to a measured pace, and that hurt them.
And that hurt the credibility of the central bank. And I also want to ask you, in a global picture, she did talk about coordination. How does she work with the Fed? It's a tough one. How can the two align?
It's a very tough one. I think they would work in a way that their reaction to similar type of data would not be completely inconsistent, but ultimately they are in different positions.
And just a final question. She talked about fiscal policy. We know very well, you know it, you're German, but of course you take a whole picture of the European Union as a whole. Fiscal policy in the EU is all over the place. What does the ECB need from a fiscal perspective to get their right policy mix?
They need as little stimulus that will push against the tightening as possible. So they want fiscal policy to take away the pain of the coming recession to individual groups. They don't want it to fight against monetary policy. Hence the whole emphasis on timely and targeted. Because if fiscal policy ends up being expansionary, what they're going to have to do is tighten even more, longer, and then all the risks will increase for the reasons you stated at the beginning.
Exactly. Well, Mr. Zettelmeier, thank you so much, of course, for that very quick reaction to that speech. It came in very handy today. We hope to see you more on Bloomberg TV. And of course, you're new to your job, so congratulations on that, too.
Thank you.
Francine, of course, the conference continues. Remember, there's also an announcement pending on the TLTROs and the German Finance Minister, Christian Lindner, who will be here in the afternoon. So a lot going on here.
Yeah, a lot going on, and I am sure that you will keep us abreast of all the new developments. Thank you so much, Maria Tadeo in Frankfurt. Now let's turn back to the UK. Chancellor Jeremy Hunt laid bare a bleak new reality for the country's economy in his autumn statement, one plagued by weak growth and rising taxes for years to come. The UK's shadow Chancellor of the Exchequer, Rachel Reeves, spoke to us earlier.
What a mess this country is in. We've had 12 years of Conservative government, 12 weeks of utter chaos, and it is ordinary working people and businesses that are paying the price for that volatility, that chaos that we've seen in recent weeks. And at the next election, people will be asking themselves, are me and my family better off with a Conservative government? And the answer will be no.
Well, to talk about the UK, we're joined by Guillermo Felices, global investment strategist at PGIM Fixed Income, and Bloomberg's John Stepek. So thank you both for joining us. John, first of all, can you just lay out what we heard yesterday? So it does seem like it's the middle-income households that are squeezed the most by the new fiscal plan.
Yeah, it was pretty gloomy. And what actually happened is that Jeremy Hunt backloaded the vast majority of the consolidation until after the next election for obvious reasons. But the people who are getting hit right now are the kind of people in middle incomes. And that's largely down to fiscal drag, which is where you freeze tax thresholds, and it means that because inflation's so high, a lot more people get dragged into higher income tax and other tax bands than they otherwise would have.
So, Guillermo, what does this mean from an investment point of view? I love this panel because we're looking at, how people are getting squeezed, and this is what John Stepek does for it at Bloomberg. He also has a great newsletter looking at money distilled. So we talk about wealth, but for international investors, Guillermo, I don't know when the right time to go in is.
Yeah, look, I think, this statement, delivered on two fronts that I think are really important for, the investment community. One is, reassuring that, the UK is fiscally responsible. And the second one is just making sure that there's confidence in the market. We had, an episode of market malfunctioning, and this statement addresses those two issues. So at least the headlines I think are very kind of reassuring for both international and domestic investors. But there's other problems that we can touch on. But the big headlines I think.
I was going to say, Guillermo, you're very optimistic to say that it's reassuring. I mean, the outlook is very grim. There is of course at least help for the needy. They're taxing the rich. There's a squeeze on energy firms, corporate tax hikes. There's a break for banks. Market's pretty much unimpressed. So again, for an investor, what's the right time? When do you call it bottom, Guillermo? When's the right time to come in?
No, so look, I mean, it depends on the on the asset. So we cannot deny that the UK is going through a very, very tough patch. We're entering a recession. We're facing higher interest rates. So for yields, for example, or for corporate debt in the UK, it's definitely a difficult time. That's why I was kind of emphasizing first you need to make sure that you make sure that you have a credible fiscal and monetary policy mix, and I think that's what the UK is achieving. Now, in terms of whether there's value at this level, say for yields or for corporate debt, I would be a little bit more cautious there. So I think for now things are coming down, but I think I wouldn't jump into these markets yet.
Yeah. John, if you break it down for us, and I think we had a survey by Resolution saying, for example, a typical household faces a permanent 3.7% income hit from these measures, bigger than the 3% hit that the top 20th will face.
Yeah, well, I mean, the top percent, obviously, they've experienced income tax cut in the 45% tax rate. So that's gone down from £150,000 to £125,140. But the real problem is these people who are in the middle, because what I think often people don't understand is that there are actually massive marginal tax rates, especially in the kind of bracket between about £50,000 and £100,000. So if you're earning £50,000 or over and you get child benefit, then child benefit gradually gets taken away. That creates a marginal income tax rate at the £50,000 area of about 60% rather than 40%. Similar thing happens at £100,000. You start to get your personal allowance taken away, which is the amount of money you can earn tax-free. That again creates a 60% marginal income tax rate for anyone on £100,000 up to £125,000. So people are already quite squeezed.
Yes.
And with inflation rising at double-digit rates, and even wage inflation, to be fair, going up at 6% a year, many, many more people are going to get pushed into those rates. So they'll be paying more tax, even though in real terms, they're actually not earning more. In fact, they're earning less.
John, so I know we don't have a crystal ball, and I know it's a difficult question, but when does it get better?
I mean, I always think this is why Jeremy Hunt has backloaded so much of this stuff, because he's hoping that he's not going to have to do it. He's hoping that come 2024, things will look a bit better. He's also made sure that he's kept mortgage rates down. I mean, I think that's the other key thing about this. I mean, what Guillermo's saying about markets is absolutely correct. The point is that gilt yields haven't gone up, which means that mortgage rates aren't going to get any worse. And I think that was the big kind of, retail investor, consumer-facing thing. But yeah, basically, he's hoping that come 2024, things will look better, and then hopefully the Tories, from his point of view, can get back in power.
Yeah, but until 2024, Graham, when do you think it gets better in terms of inflation? Like, what's the prescription to fix the UK right now? There's a huge labor shortage. The labor market is extremely tight. Is it more immigration? How do you fix this very fundamental problem?
Yeah, unfortunately, we're seeing inflation, coming up from two big sources. One is, domestically generated inflation, linked to, the reopening after the pandemic and all that. And of course, kind of the externally generated inflation linked to, the war in Ukraine, higher energy prices and all that. And you've mentioned, a third one actually that is really, really important, which is, the tightness that we're seeing in labor markets, partly because of Brexit. We cannot deny that, on the supply side, we're seeing, a shock that is not going to be, eased anytime soon. It's going to be more of a permanent shock. So the inflation process is likely to be, quite a kind of a long drawn, return to normality. I guess we can have some return, to normality from the external sources if things normalize on the commodities front. But unfortunately, we're facing some shocks that are more permanent here.
Guillermo, are you buying anything on the yield curve right now?
No, not really, not really. And what really worries me is basically kind of the issuance schedule that we have into next year. So, if you look at the DMO numbers, we're facing quite a huge issuance into 2023-24. And to me, that calls big questions about market functioning further down the line. So one has to be really, really careful about how that risk premium in the yield curve and in UK assets more broadly gets repriced. So still very cautious here.
What are you focusing on in your newsletter from now on, John? Is there anything at the margins? We spoke to the Shadow Chancellor of the Exchequer. I mean, she kind of pushed back, but also there's just a basic kind of understanding that the Tories are stealing a lot of the ideas that Labour would have put in place in the past.
Yeah, well, I mean, that was another interesting thing about the budget yesterday, is that, I mean, a lot of people were saying that, well, that could have been a Labour budget.
Yeah.
Taking money from the rich and giving it to the struggling. But I think from our point of view, the thing that we're going to be focusing on for our readers is, how do you try to, because at the end of the day, it is aimed at people who are in this bracket where they're going to get dragged by fiscal drag. So how can you cope with that, and how can you avoid it, ideally?
All right, thank you both for joining us. Guillermo Felices there, global investment strategist at PGIM Fixed Income. Also thanks to our very own John Stepek. And check out the newsletter. What's it called? Money Distilled.
Money Distilled.
It's a good read. Everyone should read it. This is the picture overall for the markets. Now, equities actually pairing some of the gains. European equity futures, or European equity stocks are gaining around 0.9%. U.S. futures also pretty much stable. Now, coming up, an ultimatum from Elon Musk is said to have resulted in an exodus of employees, putting the company's operations at risk. We'll have plenty more on that next, and this is Bloomberg.
Why would...
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
early stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Bleak outlook. The UK Chancellor Jeremy Hunt lays out £55 billion of tax hikes and spending cuts as Britons face a record drop in living standards. Risk sentiment ebbs. Asia stocks trim gains as US futures turn lower after James Bullard raises his view on how high the Fed needs to hike rates. Plus, the ultimatum backfires. Elon Musk's demand for hardcore loyalty prompts an exodus at Twitter and is said to put day-to-day operations at risk. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, earlier this week, Elon Musk issued this ultimatum to Twitter employees. He said either commit to the company's new hardcore work environment or leave. Well, the deadline has now passed, and sources tell Bloomberg that so many more workers have chosen to go than he expected, and that's leading to major complications. Well, joining us now is Alex Webb from Bloomberg. Quick take. Alex, so what exactly is he dealing with? First of all, what are we talking about hardcore? Like people left because they didn't like his antics or because they were afraid of working too hard?
Well, we don't know necessarily their motivations. We know what he was saying he expected from people, namely, yes, incredibly long hours. The sort of adjacent maybe to this this 996 philosophy you get in Asia, where you're expected to work incredibly long days and 6 days a week. There have been far more, Bloomberg's reporting, far more departures than were expected. The risk that poses is not necessarily they don't have the headcount, because there are lots of people floating around Silicon Valley right now who have lost their jobs, so maybe you can recruit some of those. But it's people they don't necessarily have people who know their systems, right? That actually they know where things are buried, they know how to fix problems.
So talk to us a little bit about the workforce of Twitter, because we all know it. I mean, it's pretty self-sufficient, one would think, because people just go on out and write. But this is what is safeguarding, it's engineers, it's people, I guess, arbitrating in disputes.
Look, there are lots of different, obviously, with any company, lots of different departments. One that a lot of people are concerned about is content moderation. That if you complain about something or you notice content that is not appropriate, or frankly that there is just proactive moderation of content, there aren't going to be enough people to do that. That's the first thing. Secondly, Elon is trying to iterate on the product itself, improve the product. You therefore need the engineers to do that, to actually come up with the new systems. And thirdly, then you just need the administration.
So Alex, how significant is this problem? Could regulators step in? Would Elon Musk suspend Twitter for a couple of days? Like, what's the way forward?
Well, we certainly know the regulators are already looking at the deal for national security reasons, partly to do with some of the comments that Elon Musk made about Russia and Ukraine. I suppose having started that process, they can also then look at other pieces of it. Look, I don't really know what Elon's going to do. I don't think Elon knows what Elon's going to do. He didn't anticipate, certainly the reporting suggests, he didn't anticipate the scale of the departures that we've seen. The one thing that's crucially different from Twitter compared to the other companies that he runs is that he basically, more or less, founded those companies. Tesla, he didn't quite found, but he was there very early when there weren't many employees. That means he forged the corporate culture at those companies. He's coming into now this place, which has its own corporate culture, trying to impose a new one upon it, and clearly that electric shock is creating a little bit of a problem.
So what do we know about sponsors? Are they leaving the platform? Are users like you and I leaving the platform?
So brands are very concerned about this. I was actually speaking to Martin Sorrell last week, the former CEO of WPP. He was saying, and I was asking about the World Cup, and he said, given the controversy surrounding it, he said that brands are less concerned about the World Cup than they are about Twitter, that they are pulling back some of their spend on Twitter to wait and see what happens. That doesn't mean they're going to be gone forever, but certainly for now they're taking a hit. And that's a problem for Elon Musk, because he has to find $1.2 billion to service his debt obligations every year. At the moment, Twitter's forecast to have negative free cash flow. One assumes that if advertisers are disappearing, that negative free cash flow is only going to get worse.
Is there another platform that people are looking into as a new Twitter?
Well, I mean, Twitter, don't forget, is a small company, right? It has 200-something million daily active users. Its revenue is less than BT's profit. It is not a big company in that scale of things. All the brands and the users have already been fleeing not just to Facebook historically, but to TikTok, a little bit to Snapchat. All of these places have become more appealing than Twitter. There is a core user group at Twitter, media types, politicians. They really like it. it's still quite good for them, and they tend to move a little bit more slowly than the early adopters we see on other platforms.
Alex, thank you so much. Alex Webb there from Bloomberg Quick Take, talking us through the travails of Twitter. Now, joining us now is Danny Rimmer. He's partner at Index Ventures, a tech-focused VC firm behind Dropbox, Robinhood, Etsy, Deliveroo, but also Glossier. Danny, thank you so much for joining us. What happens to Twitter?
Nice to see you, Francine. What happens to Twitter? Twitter is a very resilient platform. One of the things that we have to remember is that online folks continually use the platform. So I think it's up in the air what happens to it. I certainly think that Elon hasn't done anything to give comfort and confidence in Twitter, but it's still a very important platform on a global basis. So the question is how relevant it will be. That's a big question. Whether it's going to be around, that's not such a big question.
So, Danny, what you're also on to talk about today is basically the VC funding environment. So we're talking about valuations. There's been a number of layoffs, of course, in the tech space, including at Twitter. When do you expect a stabilization of this space? And what does it mean for VCs wanting to get in there?
We're announcing this new seed fund of ours called Index Origin 2. It's the second one raised after 18 months. So it's a $300 million fund committed to early seed investments. So what I was going to say is that when we look at the world, we're really looking at it from a micro lens. And this is a phenomenal time to start companies. So while larger companies are skimming the fat, are right-sizing, are having to in many cases, do some very important layoffs. Of course, there are some companies that are still growing in this period. But on the seed side, when you're really an entrepreneur trying to start a company, this is an unusually good time.
Why? Because actually, from the outside, and we talk about this all over the place and every day, the currencies are very volatile. It's difficult to find staff. So where do you see the biggest value? Like, why would you do it now when you have a cost of living crisis and inflation going up?
Well, I would say a few things. The first is when you're an entrepreneur, you're not the most rational. You've been placed on this earth to start a company that you think is going to disrupt the space. I mean, you mentioned Etsy, and you mentioned Glossier, and you mentioned Figma, Robinhood. Those entrepreneurs really started companies because they thought the world needed it. And if they were just thinking of a rational time, we'd probably not have an Uber or an Airbnb today or a Skype today. Those companies were started in this type of period. And actually, when it comes to great employees, great partners to start a company, anyone who joins a startup right now means it. They're not there for a quick buck. They're not being mercenary or think that this is the right place to be. They're doing it because they mean it, and they're really excited about the prospects of the vision of the entrepreneurs.
Danny, I've always been told that the difference between a good entrepreneur and a great entrepreneur is the money behind it, so that if it is a good idea and they're focused on execution, they can scale up quite quickly. Is there enough capital to go around right now?
I don't know who is telling you that, but I could not disagree more. Actually, from our perspective, the success of companies have been inversely proportional to the amount that they raise. So the less money they raise in the earlier rounds, the more successful those companies have been. And if we take those companies that we've been talking about, in every single case, they were single-digit financings rather than big financings. I think one of the major problems when you're starting a company is if you have too much money, you're not as creative, you're not as agile, you're not as, you don't have the same hustle mentality. So we really encourage folks to start small. And in fact, with Index Origin 2, the investments are from $1 to $5 million and no more.
Okay, I like this. So if you're an entrepreneur and you're going through a tough time, Danny Rimmer says, guys, you could be the next billionaire. How do you spot pure talent? How do you decide where to invest money in with an entrepreneur? Like, what's left to disrupt?
Well, one of them is, if they're starting a company because they want to be a billionaire, then they probably shouldn't start a company. They have to start it because they really believe that they have something better to provide the world. The founders of Figma, this company that just sold to Adobe for $20 billion. Dylan, when I met him at 19, he didn't want to be a billionaire. He wanted to provide design tools to the world. So that's what I would tell them. You know, make sure that you're in it for the long haul. Make sure you're aware that there are going to be ups and downs, and make sure you surround yourself with folks who know more than you and who are different from you, because you're going to need them and you're going to need to learn from them along the journey.
Danny, what's the most common mistake that entrepreneurs always make that you would advise against?
They come to us and they tell us how they're going to sell their company to a very large company for a huge amount of money. And we cut the meeting short and say, we're probably not the right partner. If you're thinking from day one how you're going to make money, selling the asset or the creativity that you're about to embark on, and you're in a rush, you're probably not going to build anything of value, at least not with us.
Okay, Danny, I like that. Next time we talk about the 30-second elevator pitch that you would like. Danny Rimmer, they're a partner at Index Ventures, joining us today. Coming up, we get the latest from COP27 in Egypt on the final day of the UN Climate Change Conference. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
At the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, it's the final day of COP27, and nations are still no closer to reaching a deal. Let's get out to Bloomberg's Jennifer Zavazaja, who's at the summit in Sharm el-Sheikh. Jen, I mean, I left like 10 days ago, and it doesn't seem that they did much progress. Where are we on that?
Yeah, Fran, I think that's a fair assessment because on this last day, it still feels like a deal is pretty far off. I mean, we woke up this morning and people were pretty frustrated by the fact that we don't yet have very concrete details about what this final decision is going to look like. And you can feel it in the air here. People are waiting to hear a little bit more. And the reason is because we haven't really heard much about the key issues that have defined this summit, Fran. I know you know, loss and damage, mitigation, adaptation, those are still left to be determined. We heard from the UN Secretary General and also the COP president yesterday saying that parties are still largely divided on a number of these issues. But as you can see there, what we did hear from the European Union, which could potentially be a breakthrough, is this idea of a loss and damage fund. And what we heard from Frans Timmermans is that this is the final offer. This could potentially be something that developing countries will be pleased to hear. We don't yet know. But the details of what this fund will look like is so key to getting this right. And as you know, it's all about the details when it comes to a summit like COP and getting it right and knowing who is and who isn't included, Fran.
So if we don't get a deal, or if we don't get, you know, an overall overarching deal, are there still positive outcomes from COP at this point?
I think, Fran, what a lot of people have said, you know, we were walking around the pavilion, the grounds, and there's a number of exhibitions that countries have had put up a bunch of their own solutions, climate tech solutions that they've chosen to exhibit here on the grounds. But also, when we think about something like methane, when we talk about global warming and keeping the Earth under the 1.5 degree Celsius, we did see a number of countries decide to join the global methane pledge, and that is very significant. By the end of 2030, we might see 150 nations join this. And just yesterday, we heard from China not joining that specific deal, but saying that they were going to draft their own pledge, that getting an applause from U.S. climate envoy John Kerry. So there are some positive signs here, but just a few minutes ago, we were hearing a protest that was happening small within the grounds about the lack of still action and definition about what some of these deliverables are going to be for this COP that is supposed to be about Africa and for Africa, and really about implementation and building on what we saw last year in Glasgow.
Yeah. So, Jen, what happens next?
Well, we actually just saw Frans Timmermans running by to go to his next meeting. He had met with the UN Secretary General Antonio Guterres just here. He was going to his next meeting. It's seeming like it's really down to the wire here. They're trying to get something over the finish line, but it's more likely than not that the talks are going to continue into the weekend just because there's so much that they need to hash out. And there's so much hanging on this cover document that is going to detail a lot of these issues that we mentioned. And that, I think, is really going to be telling, because that's when a lot of the people who are still waiting here to hear about a deal, to hear what the outcome of this COP is going to be like, will be able to react and see whether or not we've made any progress whatsoever, or whether things are going to get pushed again to another year, to next year in Dubai, where COP is being held.
Jen, thank you so much. Jen Zabazaja there at COP27, of course, with a great roundup of what's been going in the last 2 weeks, hoping that we still get something as we get into the final mile of the conference. Let's get straight now to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. The new CEO of FTX has laid out a list of allegations against the company's former leadership, slamming them for non-existent oversight and misuse of client funds. In a sworn declaration submitted to the bankruptcy court, former Enron liquidator John J. Ray says he's never seen such a complete failure of corporate controls. He also says advisors have located only a fraction of the digital assets they hope to recover. Japan's inflation has hit a 40-year high, with consumer prices excluding fresh food climbing 3.6% in the year to October. Core inflation has now exceeded the central bank's 2% target for 7 straight months. The BOJ continues to maintain stimulus is needed to secure stable price growth. BHP has made a second bid for Oz Minerals as the Australian mining giant looks to expand its copper assets. The offer comes 3 months after Oz rejected BHP's initial bid, which valued the company at $5.6 billion. Alibaba shares have surged in Hong Kong as investors digested second quarter results. Despite a surprise loss, analysts see total revenue largely in line with estimates. Executives are optimistic on China easing pandemic restrictions. They will also expand a buyback program. That's the Bloomberg Business Flash, Francine.
Thank you so much, Laura. Coming up, ready for kickoff. We're live from Qatar for a look ahead to the World Cup. That's coming up next, and this is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then destroy you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
Believe you me, this is the same before every World Cup. Go back to 1934 if you want, and the World Cup was in Italy, and it was used as a vehicle to promote fascism for Mussolini. There were riots on the streets by people in Brazil saying they shouldn't spend all this money on the stadiums, they should spend it on social care. We had Russia, who invaded Crimea just a few years before.
Well, sports broadcaster and former England player there, Gary Lineker, comparing some of Qatar's controversies to previous World Cups. Some will take issue to that. So you can watch the full interview he gave on Emma Barnett Meets on Bloomberg Quick Take. Now, 12 years after being awarded the tournament, Qatar's World Cup is nearly upon us. It's the most expensive World Cup ever, and the world will be watching not just for the action on the field, but for potential unrest around human rights issues. Our Simone Foxman joins us now outside the Al Bayt Stadium. Simone, the event's been plagued by controversies. How has Qatar responded?
Well, it depends on the controversy, right? So one of the controversies has been about worker rights. And Qatar has actually made several important reforms to try and improve at least the baseline standard that workers are living at. For one, they have allowed workers to change jobs more freely. They set the first universal minimum wage in the Gulf. Yes, it's only $274 a month, but that's not something that other countries have. However, activists, I should say, would like them to do more. But this is one issue. There are other issues, right? So there is LGBTQ rights. Right now, that is not something that is considered within Islamic values. And so that's being proud and being out is not permitted. Also, rights of free expression. You know, protests aren't normally legal here. We may see that come this weekend or into the next week as these games kick off. There was the potential that the World Cup could be carbon neutral. That's also something that activists have largely discredited. Yet again, you know, we have to see how this goes, because a lot of this we aren't going to know exactly how it's like on the ground until the fans all arrive, which they're doing probably right now.
This is, of course, you know, by far and away the most expensive World Cup in history. Has it been a good investment for Qatar?
You know, it's not just the stadiums like Al Bayt behind me. It's also the massive amounts of development that the country has done to try and accommodate the people that will be here, and also to try and make it a modern city. And really what you see when you drive around, if you were here 10 years ago and you're here now, is a testament to how much they've done. They've built a whole new metro system. They've dramatically expanded an already pretty exceptional airport. They've built a whole new modern port. So by those standards, yes, this has been a success already for Qatar. Will it tolerate a lot of people well? Will logistics be an issue? That remains to be seen. Also, you know, more people know about Qatar. They know where it is on a map now simply because this event is here. Qatar has been at the center of some geopolitical issues with its neighbors over the past couple of years, and it needs that global knowledge of people who know where it is, who see it as a modern city. And frankly, it doesn't matter if the talk is negative, if it's positive. If people know what Qatar is and they can associate this idea of a modern city with it, that will be a success for the Qataris.
Thank you so much. Of course, our Simone Foxman, they're on the ground for us in Qatar. Now, Bloomberg Surveillance Early Edition continues in the next hour. The focus firmly on the markets as we have more Fed speakers throughout the day. Earlier on, we were also hearing from Christine Lagarde saying that rates will rise more. They may need to be much more restrictive on economic expansion in order to drive down this inflation that's really rocketed more than 5 times. Let's remember the official target. We'll have plenty more throughout the day. This is Bloomberg.
These floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plan was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
We expect to raise rates further. And withdrawing accommodation may not be enough.
We are all united in our commitment to getting inflation back down to our 2% target. It's an open question of how far we are going to have to go with interest rates to bring that demand down into balance.
To get to this sufficiently restrictive level of policy, we'll need to increase the policy rate further.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Restrictive levels. ECB President Christine Lagarde says interest rates may need to be lifted to levels that restrict economic expansion in order to drive down inflation. Exodus. Elon Musk's ultimatum at Twitter causes more employees to leave than expected, potentially putting operations at risk. And the end of an era. Nancy Pelosi steps down as the top House Democrat, opening the way for a generational change in party leadership. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, surprised to see perhaps quite how much strength we have for European stocks and risk assets here in the European session, given the focus on tighter monetary policy we've seen from policymakers on both sides of the Atlantic.
Yeah, especially Federal Reserve policymakers who keep beating the drum toward potentially a higher terminal rate. The message is we are not done yet, so that whole pivot narrative continually gets cold water thrown on it, and yet it seems the market has faith each and every time, only to get disappointed. Now, it's interesting, as Anna pointed out, that you're seeing strength in the European session, because actually in the Asian session overnight, the strength faded as we got closer to the close of trading on the day and on the week. The MSCI Asia Pacific Index as a whole up about 2 to 0.3%, but that is significantly lower than the gains we saw earlier in the session, with gains fading for technology stocks as well, including Alibaba, which reported earnings yesterday. It was up as much as 6.7% intraday. Big gain in part due to the buyback program that they announced, but those gains faded into the close, only ending the day higher by a little more than 2%. In foreign exchange, the Chinese yuan, a big outperformer on the day. Part of that may be after a PBOC official said the country should be targeting growth of at least 5% next year, so optimism more about the Chinese economy. The offshore yuan trading at 712.72 to the dollar at the moment. And then on that positive Chinese growth story, you've definitely seen that reflected in iron ore futures, up another 1.7% overnight. Now in the month of November, up 28%, Matt. We're back up to nearly $99 a ton. Remember, we haven't been above 100 since mid-September.
All right, so some gains there. Meanwhile, we've seen some losses in crude as the futures curve signals we might be going back into contango. Real concerns about demand. I'll get to that in a second. First of all, check out S&P futures up about 0.25%, but the last few days we've seen gains in futures only to fade that trade when the market opens. We closed yesterday down again in the cash trade to 39.46, so still a relatively high level, down nonetheless. U.S. 10-year yield coming up a little bit, 380.45 is a level right now, so gaining just about 4 basis points. And we still see some really strong yields across the curve, almost 4.5% on the 2-year, more than 4% still on the 5-year, more than 4% on the 20 years. That creates real competition with equities in terms of people who are looking for yield. Here's the crude price. Right now, it's up 1/3% at $81.89 a barrel. That's for West Texas Intermediate, but it has come down significantly to more than 1-month lows. Yesterday, we were trading at $81.40, and I think Brent was coming down to about $90 a barrel for the first time since October. So getting back down as we have real concern about demand fading in case of a global recession, and all of the hawkish central bank talk from Christine Lagarde to James Bullard really weighing on sentiment for the commodity. And then Bitcoin right now, little change, up about 1/3%, $16,732.81. So Bitcoin remains relatively stable at these levels since the crash of FTX. Anna, what do you see in terms of Europe?
Yeah, more on FTX later, and the revelations from the guy who dealt with the fallout from Enron, of course. His view on FTX, really interesting. We'll get to that conversation later. This is what Europe looks like. Positive, broadly speaking, making some decent gains actually in some of these markets. Energy names not doing too badly. We have a slight move higher in oil prices, but it's broader than that. Energy stocks going higher, and utility names seem to be doing pretty well here in Europe. Let's roll over and show you some of the other themes. I also picked out oil prices, just as Matt did, to show you what's going on there with Brent. 89.86. I picked it because we're now down below $90 a barrel. So even though the direction of travel this morning is slightly higher, to Matt's point, there does seem to be a lot of focus on whether we're heading towards another glut. Some of our colleagues at Bloomberg pointing out the high-frequency data on traffic levels in China and suggesting maybe recovery, despite the headlines, is really far away for the Chinese economy, given the low level of activity we're still seeing there in some cities. Back to the top of my board, we've got the UK 10-year yield in here, 3.27%. And we did see yields go a little bit higher in yesterday's session. A lot of focus on this asset because of the budget, the autumn statement coming through from the UK government. It went a little higher. There's a lot of backloading of some of the pain coming through from the UK government, but at the same time, it was pretty in keeping with what we were seeing in US Treasuries as well, with Bullard's comments pushing yields higher, and today pretty much in keeping again as those yields tick a little higher with what we're seeing other places in Europe. Centrica also responding, continuing to respond to what we heard from the budget yesterday. Yesterday, we saw stocks in this sector. This is energy generation, gas to the home and that kind of thing. This company and others in that space doing well yesterday on the certainty and the clarity that we got around what kind of taxation would be applied, what defines windfall taxes crucially. And the euro is up by 0.1%. And actually we saw quite a lot of volatility earlier on in the day around the euro, a drop back and then a push higher. As we listen to what Christine Lagarde, the ECB president, had to say, she's talking about rates going into restrictive territory perhaps, saying there's more to be done on interest rates and talking about the prospects for recession in the Eurozone, Matt.
All right, we're going to focus in on central bankers because key figures from the worlds of monetary policy and banking are gathered in Frankfurt today for the European Banking Congress. At the event, as you mentioned, ECB President Christine Lagarde said she expects to raise rates further to drive down inflation.
Inflation in the euro area is far too high. It has reached double digits in October for the first time since the start of the monetary union. And with inflation likely to remain high for an extended period, we need to monitor the evolution of inflation expectations very carefully. Additionally, although recent data on GDP growth have surprised on the upside, yes, yet the risk of recession has increased.
Maria Tadeo, our European correspondent, joins us now from Frankfurt. So, Maria, what were the other highlights that we heard from Lagarde's speech?
at a conference that you used to cover.
Yes.
And Matt, it's always interesting to be here, of course, because you have the central bankers and then you have the bankers too that kind of come together. But in that speech, two things that really stood out. One is Christine Lagarde saying, despite the fact that there has been better than expected data coming out of the European economy, don't be fooled. The idea of a recession is still there, and the chances of it actually manifesting have increased. And the other thing, of course, is that she repeated, the European Central Bank has a mandate that is to bring back inflation to target, and therefore will continue to increase rates. So to me, it's pretty clear that they will continue to hike in a recession, and that is potentially where we'll be in December when they meet for the last time this year. Now, that's for the speech. Of course, the question continues to be, will it be 50 basis points? Will it be 75 basis points? I think from the speech today, it's very difficult to really get a sense of which way it's going to fall, because she hedged it quite well. She said, of course, we need to deliver on the mandate, continue to hike, but at the same time, this is data dependent. Now, another final thing, Matt, in about an hour from now, we are going to get data from the European Central Bank on the TLTROs. Remember, this is a cheap funding by the European Central Bank. We'll find out whether or not, I believe in an hour, if banks actually decided to use this window to pay it back. A lot of analysts out there say anything less than 500 billion euros in early repayments today will be a disappointment for the ECB.
All right, Bloomberg's Maria Tadeo in Frankfurt. Thank you so much. Let's get to tech news now. Twitter has closed its offices until Monday after Elon Musk gave staff an ultimatum to either commit to working long hours at high intensity or to leave and get 3 months severance. Sources say many more workers declined to sign Musk's pledge than expected, and potentially that puts Twitter's operations at risk. Alex Webb of Bloomberg Quick Take joins us now for more. So Alex, to be honest, I spent the morning thinking about setting up a professional Instagram account if Twitter is on its way out. Is that realistically what we're looking at? Is Twitter going to die?
I think it's highly unlikely that it dies. It's got a very committed base of users as a hardcore group that continuously posts even despite these problems. The risk is the advertisers, that if the advertisers disappear, the revenue dries up. There are a lot of risks associated with, for instance, cutting the moderation staff. Brands don't want their ads to appear next to content that is problematic. But Elon Musk and his investors have spent $44 billion on this company. They will not want it to go under. He does have access to a whole bunch of other capital if he absolutely needs it, by selling down his Tesla stake, for instance. Obviously not what he wants to do if he can help it. So is Twitter going to die? It would seem unlikely, but there is a huge risk to the company being able to continue operating effectively.
It was really interesting to see them have to shut one of their buildings yesterday, because in all the uncertainty about who was accepting the severance and who was going to stay, there was a lack of clarity about who really still worked there and therefore who was allowed in, which was quite an interesting development. Here in Europe, it seems that regulators are very keenly watching the level of moderation that is going on over at Twitter. One EU internal market commissioner saying that he will have to increase staffing levels on that.
Yes, we've just seen a whole raft of new legislation introduced at the European level, which categorize certain companies based on how many users they have, revenue, all that sort of thing, as gatekeepers. And if you're one of these companies, you have to not only have more it's harder to do deals, but there's another piece of it which says you have to obey certain rules when it comes to content. And so Twitter, when it comes to content, is one of those companies. It therefore has obligations it needs to follow legally at a European level. If it doesn't have enough moderators, it will struggle to do so. That's why I think it was Thierry Breton flagging this morning has made this point.
All right, Alex, thanks very much for joining us. Bloomberg's Alex Webb talking to us about the developments over at Twitter as more and more staff flee. Now let's get to U.S. politics. Nancy Pelosi stepping down as the Democrats' leader in the U.S. House of Representatives after holding that role for almost 20 years.
And with great confidence in our caucus, I will not seek re-election to Democratic leadership in the next Congress. For me, the hours come for a new generation to lead the Democratic caucus that I so deeply respect.
Bloomberg's Anne-Marie Horton joins us now for more. So, Anne-Marie, with the octogenarians starting to pass the torch, who are the young bucks that are taking over?
Yeah, clearly this is going to be a massive shift for the Democratic Party, and it really is a new era
of leadership for many years. Actually, they have been pushing for this, but finally yesterday with Speaker Pelosi saying she will step down from the leadership post. She, of course, will still be in the halls of Congress, she says, representing her San Francisco district. All eyes are on Hakeem Jeffries. He is, of course, the representative from New York, and he has even been out during the midterms, out there with other Democrats, making sure people are voting for them to make sure they can try to at least fend off what they successfully did in terms of a red wave. And it does seem like everyone is rallying by him to take on that leadership position. Also, some other names to keep an eye on: Pramila Jayapal from the Progressive Caucus, as well as Catherine Clark from Massachusetts. These are going to be the big names to watch in this fresh generational shift. We should also note, though, for Speaker Pelosi, she did receive praise, even begrudgingly, from Republicans. One Republican from Oklahoma said, listen, you have to have a lot of respect for her. It's like the admiration of someone that you hate on another team, but you still admire them because they're the best player. So big shoes to fill for the Democrats.
Sounds like me with Tom Brady, Anne-Marie. So clearly there's a lot to pay attention to domestically, but geopolitically as well. We had news overnight that North Korea test-fired a suspected intercontinental ballistic missile with an estimated range long enough to reach the American mainland. What has been the response from the U.S.?
Yeah, really all eyes continue to be in the Asia Pacific from the United States, and you have Kamala Harris, the vice president, representing the U.S. at this APEC conference when this happened from North Korea. So she had this impromptu meeting with some of the allies like Japan, South Korea, Australia, and they obviously are condemning what went on with North Korea. And also she says the U.S. has an ironclad commitment to their allies in the Asia Pacific. For Japan, this is obviously another level of concern, because what the Japanese prime minister believes is that this likely landed in Japan's economic exclusion zone, something we haven't seen in the past 8 months. And what Japan is saying is that these provocations from North Korea are just happening at a more aggressive space. On Sunday, President Biden met on a trilateral level with South Korea and with Japan to discuss this. And what we were told before he went into that meeting with Xi Jinping is that he was going to tell Xi, rein in North Korea or expect a bigger military presence right here in the Asia Pacific.
All right, Bloomberg's Anne-Marie Hordern, still reporting from Bali. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And there's some pretty big moves for some of the retailers. Ross up 16.4% in early hours. Apparently, a lot of people are dressing for less because it posted a beat and race quarter, so getting a nice reward for that stock. And another nice reward for another retailer, and that would be Gap. They also beat expectations. Really shows that they're having more progress managing their inventory, and also they did take a $53 million hit from taking off Yeezy merchandise due to the whole Kanye or Ye West debacle, but nonetheless that stock is higher by nearly 8% before the bell. And one final mover to the upside, Applied Materials. This is the biggest maker of chip manufacturing equipment. The fact that supply chains are easing up and making things easier on the supply side is helping offset some of the softer demand from the macro environment. So they were able to top expectations better than feared. It is up about 4% before the bell, Anna.
Okay, so those are some of the pre-market movers. Kaylee, coming up on the program, Koku Ankublower joins us, head of UK research at Societe Generale. We'll ask him about the UK, also get his global perspective on what's happening in markets, the higher rate environment, the question around where terminal rates head to, and Bitcoin may be weathering the gloom, but the FTX saga continues. We have the latest on Sam Bankman-Fried and the FTX drama. Plus, the world's fastest growing economy bets it all on oil. Read more of today's big take story on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller here in New York at Kayleigh Lyons. Anna Edwards with us out of London. We are hearing more and more about restrictive rates from central banks around the world. Yesterday, Jim Bullard laid out a restrictive rate that would be between 5 and 7%. He said using some kind of Taylor-like rule. That's even higher than we heard from Jerome Powell at the last Fed meeting. So that's what's concerning markets. In Europe, you're hearing the same kind of thing from Christine Lagarde. Joining us now is Irina Garcia Perez, Bloomberg debt reporter. So, Irina, how is this affecting markets?
Well, the likely impact is going to be an increase in default rates inevitably as the outlook for companies worsens as it's more expensive, basically, to service the debt.
Irina, good morning to you. What are we hearing on the opportunities in the corporate debt space at the moment? I spoke to a guest earlier on who was sort of suggesting there might be opportunities in the short term as spreads have been coming down, actually, since we got that potential peak in inflation in the United States. But then when recession starts to really bite next year, things could get tougher.
Yeah, so the tricky part here for investors is to be comfortable with the outlook in terms of there's a lot of volatility. So being comfortable with the outlook of how companies are going to perform and when is a good moment to get in, that's getting very, very complicated.
And as we think about kind of the health of corporate balance sheets, the narrative going into this tightening cycle was we're going to be able to withstand it more so, given how healthy things were. Now that the tightening is still underway, what is it looking like? What default risk are we looking at this cycle?
So it's worsening, but the picture is still way better than what we saw, say, in 2009 or even in 2003. So S&P, for instance, is expecting the default rate in the worst-case scenario to be around 5.5% in September next year, but that's far from the 8-9% that we saw in 2009.
Irene, thank you very much for joining us. Bloomberg's Irene Garcia Perez with a look at the corporate debt market. And for more on the markets, you can check out the Markets Live blog. MLIV Go is the function to use on your Bloomberg terminal. This is Bloomberg.
covers the world like Bloomberg.
My team thinks 2023 we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Stages of a sustainability revolution that has the magnitude of the Industrial Revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. North Korea has fired a suspected intercontinental ballistic missile a day after warning the U.S. over continued military drills with allies in the region. Japanese Prime Minister Fumio Kishida says that missile probably landed inside the country's exclusive economic zone. In an effort to break deadlocked climate talks in Egypt, the European Union has proposed a loss and damage finance facility for the most vulnerable countries. EU climate chief Frans Timmermans put forward the offer in exchange for a pledge to reduce use of oil, gas, and coal. It comes after days of little progress at the COP27 talks in Egypt. The new CEO of FTX has laid out a list of allegations against the company's former leadership, slamming them for non-existent oversight and misuse of client funds. In a sworn declaration, former Enron liquidator John J. Ray says he's never seen such a complete failure of corporate controls. He also says advisors have located only a fraction of the digital assets they hope to recover. And JP Morgan Chase is making sweeping improvements to its employee benefits, including giving 16 weeks of leave for the birth or adoption of a child. The bank will increase sick days for full-time employees to 10 days from 6 and bump bereavement to 20 days. Under a new policy, employees will also be eligible for up to 4 weeks paid time off to care for a seriously ill spouse, domestic partner, child, or parent. The new benefits start on January 1st. And of course, Anna, it's interesting to see these kind of benefits conversations because for so long over the last 2 years, we've been talking about the issue of retention at some of these banks, especially as they ask people to return to the office rather than working from home. Perhaps you have to incentivize them in other ways.
Absolutely, something we increasingly we're seeing guests taking the opportunity to take extended paternity leave, which I think is an interesting development. We'll try and get some stats on that. Let's tell you what's coming up on the program. We'll talk to Koku Agbubloa, head of UK research at SocGen. That conversation coming up next. This is Bloomberg.
we've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and your work. I know I deal with that all the time. This is really a people-first company. And even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and we'll continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Restrictive levels. ECB President Christine Lagarde says interest rates may need to be lifted to levels that restrict economic expansion in order to drive down inflation. Exodus. Elon Musk's ultimatum at Twitter causes more employees to leave than expected, potentially putting operations at risk. And the end of an era. Nancy Pelosi steps down as the top House Democrat, opening the way for a generational change in party leadership. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, European equity markets perhaps surprisingly buoyant today for this Friday, given the level of kind of hawkishness that we've heard from, over at the Fed, Jim Bullard, but also from Christine Lagarde. A lot of talk about restrictive levels.
Yeah, absolutely. Although this is nothing new. I mean, anyone who's been paying attention to Fed speakers and to the situation in the UK and Europe knows that something drastic has to be done, and they continue to pledge they'll do it. Take a look at U.S. futures. We are up on the day after Bullard said restrictive rates need to be between 5 and 7%. Now, I guess that could surprise you, but people were talking about a 6% terminal rate at the last Fed meeting, so it just seems like investors, equity investors at least, have a very short memory and continue to think that a pause or a pivot is coming even as often as Fed speakers tell us it's not. The U.S. 10-year yield rising 3 basis points right now, 379.52. So maybe all of this here is priced in. NYMEX crude right now up about 0.25%, but it had come down yesterday to the lowest level that we've seen in about 6 weeks. Brent as well on concern that these restrictive rates are going to cause a recession and fewer people are going to buy gasoline. It's about the demand side problem, not about the supply side for oil. And then Bitcoin, it's up 0.8%, getting back up towards 17,000, but really it's been hovering with the 16 handle all week and basically since the collapse of FTX. Haley, what do you see in the pre-market?
Well, there are a lot of earnings winners in early hours trading today, some of them remaining retailers, which of course has been a very mixed bag throughout the week, but it was definitely a positive story for Ross, which posted a beat and raise quarter, boosting its outlook on sales momentum. Of course, it's a discount retailer, so maybe a lot of people are looking to steal some deals in this kind of macro environment. That stock is up 16.4%, and Gap, which also managed to top expectations, is higher by about 8% as it has a better job managing its inventory. Palo Alto Networks, which is a cybersecurity company, also managed to top expectations. Analysts really saying that they are working through the difficult macro environment. It's up about 8.5% as it beat on really all of its metrics. And finally, Applied Materials. This is the biggest chip manufacturer, maker of that equipment. It is up 4%. Yes, it's dealing with the softer macro picture as well, but the fact that supply chains are easing, helping out that company in pre-market trading, Anna.
Kaylee, European equity markets then. A lot of your pre-market movers look positive. Well, European stocks looking really positive, perhaps surprisingly so, up by more than 1% this morning on not very clear drivers. We've heard some hawkishness from Jim Bullard, hawkishness from Christine Lagarde, the ECB president there. But still, European stocks move higher. A lot of sectors in positive territory. Utilities, energy stocks moving higher. The UK 10-year yield in focus. Gilt markets broadly in focus in the aftermath of that autumn statement yesterday. Clearly going down much more calmly with markets than did the so-called mini budget, which was entirely the intention of the government, I'm sure. 3.26% the yield on the 10 years. So we do see that yield ticking up a little, and it did do yesterday, but that was in keeping with what we'd seen in more global trends as well. Centrica is up by 2% this morning. Yesterday we saw this sector, so this is energy businesses, companies that provide energy to the home and beyond. They were doing actually pretty well yesterday. We got some certainty in that autumn statement from the Chancellor about what defines excess profits and therefore what the windfall tax was going to look like. And in amongst that certainty, we saw this company and others in the sector moving higher. The euro is pretty flat today, but it's been really quite volatile. 103.66 is now where we trade. Been quite volatile as we've listened to Christine Lagarde at the ECB talking about the level of restrictive territory that's needed and the risks of recession, Kaylee.
Yeah, Anna, so interesting to see policymakers really across the world talking about rates that need to go even higher. You mentioned Jim Bullard saying that terminal rate of 5 to 7% could be appropriate, and certainly that would mean the market may have more work to do. Let's continue this conversation with Koku Agboola, Global Head of Economics, Quant, and Cross-Asset Research at SocGen. So Koku, clearly you know a lot of things. As we talk about what we've heard from central bankers this week, where the market expectations of how high rates ultimately go are versus what they're saying, are we appropriately priced?
I think the market is expecting a cut in June of next year until sort of the middle of 2024, if you look at U.S. swap market. And we think that it is not appropriately priced. Our view is that the fight against inflation is not over. And to quote Winston Churchill, who famously said after the defeat of the Nazis at the Battle of El Alamein, in November of 1942, that this is not the end. It's not even the beginning of the end, but possibly the end of the beginning. And in our view, the peak of inflation will look more like an inverted U as opposed to a inverted V. If you take the analogy of what we were discussing in terms of U-shaped, V-shaped recovery in 2020. So it means that there's a couple more hikes, and then we'll see a plateau. Because you need a lot of more sort of restrictive monetary policy to bring inflation down from the 6% back to the 2 to 3%, and that will need a lot more tightening and demand destruction.
Okay, so an inverted U is what the inflation picture looks like then in your eyes. Koku, good morning, nice to see you. But at what level does that U sort of plateau? Yesterday we heard, as Kelly was saying, from Jim Bullard, and he was talking about 5 to 5.25, but there were parts of his presentation that seemed to nod towards the idea that things could go much higher. I mean, it's 7 even featured on some of the charts he was dealing with. What are your expectations of the terminal rate?
Yeah, and this is an interesting point because we did some calculation. If you take the Taylor rule and you use unemployment or sort of GDP as an input, you would actually get between 5 and 7% for the neutral rate. And therefore, our view is that it should plateau between 5 and 6%, roughly speaking. But it will clearly depend, obviously, on how sticky the inflation market is, core inflation is in terms of rent and wages, etc. But it is also very important to realize that it takes 3 to 5 quarters for an interest rate hike to have an effect on the economy. So by the time we reach H2 of next year, we will have had a cumulative effect of over 500 basis points of tightening. And this is only then that we'll see whether it has been enough or not. And ultimately, our base case scenario is, yes, let's say between 5 and 6%. And then the Fed will pause, and then we'll have to cut as the U.S. economy enters a shallow recession.
how do you expect earnings? Wait, a shallow recession. How do you differentiate between a shallow recession or a deep recession? What makes the difference there in terms of what we're doing now for next year?
Yeah, I mean, the difference will be 2 consecutive quarters of negative GDP growth in the sort of a few tenths of a percent, as opposed to what we all see in the UK, for example, where we expect a negative 1.4% GDP growth in real terms for next year. And I think this is sort of the difference, because you also have a lot of automatic stabilizers, cumulative excess savings of close to $2.5 trillion, corporate balance sheets being roughly fairly resilient compared to where they were in 2008, for example. And then government as well, injecting some fiscal stimulus, plus the Green Deal or the energy transition investments that are all offsetting some of that tightening.
Well, Coco, you mentioned the new GDP forecast of a contraction of 1.4% next year. How much downside risk is there to that and in the years that follow based off the autumn statement that Jeremy Hunt gave yesterday?
Yeah, so I think with regard to so it will clearly depend obviously on the mortgage market and the marginal propensity to spend, which will clearly hit the middle income in the UK, as we saw. So I think there essentially could be some downside, but I think that the budget has been fairly balanced with some investment and growth programs as well to avoid a protracted depression, so to speak. But I do think that if you take a step back and you see what's been priced already in terms of the weakness of the sterling and China that could potentially come out of its net zero, zero COVID policy, you could see a sort of stabilization of global growth, and that could potentially help the UK recover in that regard.
Can I take us somewhere slightly different, Koku? And that is, in the aftermath of the collapse of FTX, some of the revelations coming out about the business itself, maybe around the sector, really fascinating and quite shocking in some cases. How have you been thinking about your expectations for either crypto or for blockchain technologies, crucially, as we move through this period of volatility for the asset class?
Well, I think banks in general have looked at the crypto in terms of its technology, blockchain, and how it could be applied to the sort of value chain in the banking system. I think most banks have sort of, if you look at it from the regulator, have sort of stayed away to some extent, but they've been some work done on CBDC, so central bank digital currencies. But the asset class has clearly sort of expanded in terms of the financial derivative markets. You start to have futures and different derivatives on that. But the high volatility is something that requires more regulation, and I think this is probably going to occur over the next few months after the FTX debacle.
Koku, thank you so much. Thanks for joining us. Koku Agbabloa of Societe Generale, thank you very much. Coming up, we hope to dive into some of the detail around FTX. The fallout continues. We'll bring you the latest on Sam Bankman-Fried and the contagion that's followed. This is Bloomberg.
Stronger that moment that you're lifting the barbell. You get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech in sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body And what just tricks the mind?
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Matt Miller in New York and Anna Edwards in London. Now a look at what is coming up today. The Asia-Pacific Economic Cooperation Summit continues. President Xi Jinping and Kamala Harris are among leaders set to attend the event. We'll be getting some U.S. economic data, including existing home sales, plus more Fed speak. Boston Fed President Susan Collins will be speaking at 8:30 a.m. New York time. And then over the weekend, the 2022 World Cup kicks off on Sunday, bringing billions of viewers and millions of fans to the tiny Gulf state of Qatar. And on that note, Qatar and FIFA have promised that the 2022 World Cup will be carbon neutral. As the tournament begins, though, environmentalists are raising alarms, saying the event has been greenwashed.
In 2010, FIFA announced that Qatar would host the 2022 World Cup. In its bid, the country promised to make it a carbon-neutral tournament. But as the matches approach, environmentalists are claiming that Qatar has greenwashed the World Cup and that the event will put millions of megatons of carbon dioxide into the atmosphere.
So that claim is mostly a PR play. Essentially, there is no way that a mega event of that size can be carbon neutral.
FIFA can do better and should do better. And you know, my focus would be on encouraging to do that for the next World Cup.
The UN defines carbon neutrality, or achieving net zero carbon emissions, as balancing a measured amount of carbon released with an equal amount offset.
First step is to measure your emissions, and so that's what FIFA has done for the World Cup. We looked into that calculation, and we think that this is quite significantly underestimated.
So there's two big challenges with any carbon neutrality claim at an event of this size. The first one is travel. And the second part of this is construction.
75% of the carbon footprint of all sports stadia over their entire lifetime is locked in on day one from the materials they're built from. It's not about operating costs, it's about concrete and steel.
Qatar has invested billions of dollars in infrastructure for the tournament, including building 7 new stadiums. Organizers estimate that the World Cup will emit 3.6 megatons of carbon dioxide.
The construction of the stadium is the most problematic element because it's the element that we think was most massively underestimated. From that factor, we think the total footprint would be 5 million tons.
International flights in and out of Doha will account for the majority of emissions. However, organizers argue that this World Cup will be more energy efficient than others, since fans won't have to fly to different venues and can instead just take public transit.
The sticking point is always the flights. Most Olympics and World Cups, it accounts to more than 85% of total emissions.
Balancing carbon emissions with offsets is key to carbon neutrality. So far, Qatar has purchased less than 350,000 carbon offset credits of the 3.6 million needed in their estimation. The Supreme Committee says that it has already secured a minimum of 1.5 million credits from the Global Carbon Council, and that further details will be forthcoming. So far, greenwashing issues are not keeping fans from rooting for their teams on the pitch. An estimated 1.7 million people will be in attendance, with over 3 million tickets sold. But with a warmer future ahead, effects on fans will soon be felt.
Sport is the most enormous opportunity to tackle the climate crisis because we can engage football fans and make them fans of the environment through their favorite sport.
Bloomberg's Simone Volksman reporting there, and Simone joins us now from outside the Al Bayt Stadium. Simone, a very good to have you with us on the program. That package there dealing with the green element, there's been some criticism on various fronts ahead of this World Cup. One of them around the green issues, as we heard there, also around construction and the conditions for migrant workers. There has been so much construction. I was in the country 10 years ago, and then a lot of the places where games are going to be hosted didn't even exist. Is this considered a worthy investment? Are Qataris pleased with what they have produced here?
I think they absolutely are. And I think that what they say is that showing that a small country with a population of just 3 million people can actually carry out an event of this scale, build all the construction, all the new roads, all the new metro system that are necessary to kind of keep fans happy and get them from place to place, that alone in itself says to their world partners that they can do stuff and that they can be relied upon to even when the going is tough. And the going has been tough for them. In addition to the development goals that were part of hosting the event here, note that just 5 years ago, Qatar's neighbors, Saudi Arabia, the UAE, and Bahrain, as well as Egypt, cut off abruptly trade, diplomatic, and travel ties, leaving Qatar essentially out on its own. Although they have come back into the fold, it's important for Qatar to have people know what they are, who they are, where they are, in protecting their sovereignty, frankly, going forward.
Well, what about the fans? I mean, this kicks off on Sunday, right? I guess people have spent thousands and thousands of dollars on tickets, not even including airfare, under the assumption that beer would be sold, right? They agreed to sell Anheuser-Busch or allow Anheuser-Busch to sell beer. And now we're hearing that they may reverse that decision. Is that true?
Yeah, just in the last hour or so, we learned that no longer would actual alcoholic beverages, specifically beer, be sold inside the perimeter of the stadium. Now, it was already going to be curtailed. You were only going to be able to buy it outside the stands themselves and in the hospitality suite. And for outside the stands themselves, you were only going to have the windows 3 hours before the start of the match and then 1 hour after the match to be able to purchase Bud Light. But now it looks like there's going to be no beer in the stadium at all, except for those hospitality, those high-end clients that are sitting in the key seats. Yeah, exactly. You know, look, this is not a place where alcohol is completely banned. You're going to be able to go to hotels and restaurants attached to them and still be able to purchase alcohol at a price, mind you. It is very expensive, some $12 for a pint of beer, pretty much at minimum. You know, that said, I think the goalposts have changed this late in the game. Remember back in August, we saw the date of the opening match shift a day earlier. It just kind of makes you wonder how much is still shifting in the organizer's head. We're like 48 hours out from the opening ceremony.
All right, Bloomberg's Simone Foxman reporting from outside a stadium in Qatar. Thank you so very much. And again, the World Cup begins on Sunday. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in, The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
FTX was very centralized. It was all centered around this one guy. And when you centralize anything, bad things can happen.
That was the chairman of DFJ, Tim Draper, speaking with Bloomberg on the collapse of FTX. Now, the new CEO of FTX has laid out a list of allegations against the company's former leadership, slamming them for non-existent oversight and misuse of client funds. Ana Herrera, Bloomberg senior crypto editor, joins us now for more. And it's pretty damning, this, I guess, testimony, in a sense, of the new CEO, because he's overlooked horrendous bankruptcies and scandals like Enron.
Exactly, yeah. So he didn't hold back at all. He painted a picture of a company, basically complete chaos, where no one really had any control on anything. They can't really figure out how many employees even worked for FTX. They don't have any control of where the cash is. They're trying to figure out how to manage this bankruptcy. So, you know, it keeps getting crazier the more and more we actually get into it and hear what was going on. You know, they talked about loans from one of the companies to some of the main players as well, some of the executives, including Sam Bankman-Fried. So it's just quite, you know, jaw-dropping.
So, Anna, are there any shoes left to drop or dominoes left to fall?
I mean, yes, I guess we will still know. They alluded at some of the things that have come out in media reports, so exactly sort of what happened with customer funds, and also, you know, there is no clear picture of how many liabilities they still have with customers, so that, and you know, where the money went. So we're still waiting to hear about that, and obviously who the bigger creditors are. There's still so much that has to come out.
It's amazing, isn't it, the revelations coming through from this kind of reporting about the way that the business was run, as you say, the things they don't know about employees and where the cash is. The new CEO also suggesting that investors should not obviously rely on audits that have previously been done. I suppose this just raises questions for other businesses in the sector or elsewhere. You know, raises questions once again about what public information is available and how much you can rely on it.
Yeah, so in crypto generally, there's a lot of talk of transparency, but for exchanges, there isn't that much of information available. And in some cases, even the audits aren't that reliable. You know, they said do not trust the audits here. And that's because there's no separation of powers. And so you might have, you know, the exchange being the custodian, being the trade repository, the central clearing counterparty. So it's all kind of mixed up. And obviously, when you mix up roles, you have conflicts of interest potentially.
And when you don't write anything down, except for in your Slack chats, it's pretty difficult to
with
keep
emojis.
records. Yeah, with emojis. Anna, thanks so much for joining us. Ana Herrera covering crypto for us out of London. Tune in to Bloomberg Crypto every Tuesday at 1 p.m. New York time, 6 p.m. in London. Our weekly show, Kaylee and I host it, shows the people, the transactions, the technology, everything around the world of decentralized finance and centralized collapses like that of FTX. That's it for Early Edition. Surveillance is ahead. We'll hear from PIMCO co-founder Bill Gross, among others. This is Bloomberg.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Inflation, both here and globally, is a problem, and central banks have created, or at least made the problem worse.
The end of the inflation problem is probably in sight.
I think the market's trying to find its footing.
The market is getting poised for a breakout, even more inverted from here.
The market strength has brought with it looser financial conditions, which is not what the Fed wants.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Friday on radio and television. We welcome all of you. I'm out on Twitter. I've just been tweeting here moments ago, Lisa, and maybe I'll get one more tweet in.
Yeah.
That's the kind of morning it is.
Okay, we're having turmoil, basically an exodus from Twitter after he said that they're ready to go hardcore and press this button if you want to be in.
Surveillance is hardcore.
No one really pressed that button, evidently, and so now he doesn't seem to have a staff, and people are worried.
For those of you that went to bed early last night, social media, with all that's going on in Bitcoin, and we've got so much to talk about on a Friday to prepare for the weekend, to get into the holiday season, to look at equities, bonds, currencies, commodities. About 11:30 last night, something original happened. There's nothing else to say.
Basically, full-scale revolt by an entire staff of a company. And how much are you looking at something that is idiosyncratic to an Elon Musk world, to something that is a Twitter world and a private company that once was public? And how much is this really, this question mark around social media platforms right now? Because there was a story in the Wall Street Journal also this morning that Meta laid off a number of staff for taking bribes to interfere with certain accounts. My point is, this really shows how much of a complete sea shift there is in companies once very highly valued.
Yeah, it's going to be interesting to see, and we're going to be, of course, covering this through the day. Katie Greifeld, I believe, scheduled on the crypto uproar somewhere through the morning as well. And we're thrilled, I hope, to bring you Mandeep Singh of Bloomberg Intelligence, who's encyclopedic on what goes on behind the walls of these Silicon Valley companies. This is a moving story, and Bloomberg will be covering it through the morning. I think we've also got to look at further curve inversion. To me, the bond dynamics, Lisa, continue, and that's been the story of the week.
And it hinges on all of the speak that we've been hearing from the Federal Reserve and now Christine Lagarde, who earlier this morning, European hours, said that perhaps they need to lift rates even further, and talked about how even the risk of recession isn't sufficient to really stop them from continuing to raise rates.
Did she go half bullard or full bullard?
Yeah, exactly. Did she say 5 to 7%? That 7% number
that stopped the markets yesterday.
That did stop the markets. And I was speaking yesterday with Tom Kennedy of JP Morgan Private Bank, and I said to him, is this realistic? He used to work at the New York Fed. He said, yes, it is realistic. And I said to him, well, what probability would you assign a 7% rate He said 15%. That's not nothing.
Well,
it's small, but it's not nothing.
John Farrell's still out on assignment, and I got to admit, John has been looking forward to the inflation report we get before the next Fed meeting. But I would say with the rapidity through the week of layoffs, including at Amazon and others, everybody's got their own story here. All of a sudden, the jobs report, first week of December, has a new weight to it.
Will it be bad enough? And that sounds really perverse.
I actually thought, my little brain thought of that this morning as I was putting out my last tweet.
But this is unfortunate. You don't want to be saying this. This is a perverse thought. Will it be bad enough to be a good thing for the market and a good thing for the Federal Reserve? People want to see softening. But I want to, we talk about the layoffs that we've seen. Morgan Stanley yesterday, the team putting out this, and I thought it was interesting. Layoffs in the tech sector are making headlines, but it's just a small part of the overall story. And this is really in theme with other people who are saying they expect firms to hold on to workers through the growth slowdown, and tech is a specific area that is not.
Here's the headline for you on radio and TV. It's not a quiet Friday. We're going to do that with the data here, up 25, a little lift to the market. Really don't know what to make about it other than maybe Fed hope is how I'd put it. A story worth looking at. Marita Sen's scheduled to be with us here on oil now, again under $90. Brent crude, the global price, $89.24. West Texas Intermediate, $81.33. Maybe this is the growthiness fear out there, including a reaffirmation of China slogging along as well. 10-year yield, 3.79%. 2-year yield, remember, 5%, anticipating. That's the last time Faro was working. We were talking about getting out to 5%, 4.48% on the 2-year yield. Dollar with some weakness. I need to be briefed while I look at the Twitter to see if it's still working.
Okay, well, you check out your World Cup bracket and Twitter to see whether it's still working. I'm looking at central bank speak. Today, it includes Bundesbank President Joachim Nagel, ECB's Klaas Knot at 8:15, and Bank of England's Catherine Mann at 8:15. They're speaking over at the
Mann
confab.
is wicked important there.
Exactly, I would agree with that, because how do you dovetail a weakening economy and the need to be hawkish and to fight inflation? Then we hear from the Boston Fed President Susan Collins at 8:30 a.m. As far as the U.S. data, not that loud on the front, but this to me is going to be interesting. 10 a.m. we get U.S. existing home sales, and how much do we see that ongoing weakness? On Tuesday in the U.S., we saw a read for the home builder sentiment, the NAHB data of information coming in at the weakest when you take out the pandemic, the weakest reading in more than a decade, just to give you a sense of where we are.
And on radio, this chart that Lisa put up is absolutely perfect. And on radio, all you need to do, and we all know this coast to coast, plunge is the only word that works here.
And that really confirms what we're seeing in other indicators as well. And Sunday, of course, we'll be hearing about the World Cup, which begins in Doha.
Is it this Sunday? I didn't know that.
Winter edition of
I'm
the
trying
games.
to read. Good morning to the Athletic, doing a great job on this.
I would agree.
I'm trying to read on it.
It's the most expensive one ever. $300 billion.
Yeah, but the breaking news is they're taking alcohol out of it. You talk about the business of this. I guess they have an agreement with Anheuser-Busch of St. Louis, and they're taking Budweiser out of the stadium, and it's going non-alcoholic. And if you're, a fighting buffalo from Boulder, you know that the only thing non-alcoholic is what's called Coors 3.2 beer.
Okay, all I can say is that would be the breaking news by you, Tom. You're like, the breaking news is not how much they spend. It's not that they're starting the World Cup. No, they're not going to allow alcohol.
I want John to go to London with this seriously wonderful knowledge, and I'm going to go to the sink in Boulder, Colorado, and have Coors 3.2 and watch every moment of every game. You and me, glued to this, is where we will be. Right now, we are glued to get you started strong, and we do this with Christian Nolting, Global Chief Investment Officer, Deutsche Bank Private Bank, with a real holistic view of where we are and how to recalibrate. Christian, how do you recalibrate into 2023?
Yeah, first of all, I think you mentioned inflation already. That will be a main and very, very important topic. And what we see is, I think inflation will come down. So we probably have seen the peak in the US. We will soon hopefully see the peak in Europe, so that there's a bit more to come. And then what's the central bank reaction function? I think that will still be the main topic. And from our point of view, I think we have to be a bit careful. We are not in the camp that the Fed is cutting next year. If you look at the experience in the 70s and 80s, maybe they just wait. And I would be surprised to see the ECB cutting, and we even thinking maybe they go higher than the price 3%.
You have the advantage at the Deutsche Bank shop of David Folkerts-Landau, Alan Ruskin, Sarah Vellis, and the team there, and they always have a depth of history to them. Is there any indication by your shop that this idea of a pivot in 2023 is historically based? Is it a fantasy? Is it a guessing game, or is there a real history that it can happen?
Look, first of all, I would always say past performance, and you know the continuation of this, right? So, and I think this kind of inflation is a bit different because it's coming much more from the supply side and not so much from the demand side. And from that perspective, I would not really look into the past to draw some massive conclusions out of this. What we can see from the models is that we think inflation is sticky, that we are not going very fast back to old levels. And I think that's what central banks have to see as well, and rather be cautious in to cut too early.
I really don't want to say this. I actually hate saying this word. But does it feel like the pivot is more believed in Europe than in the US right now?
Not too sure, I would say. So I think there's at least some discussion, and if you look at market pricing, that the Fed is going to be slower in hiking, and that's not a pivot from my point of view. But we are not in the camp that really the Fed is cutting. On the ECB here in Europe, I would say the market is not seeing a cut, nor do we. We would rather say maybe the ECB needs to do even a bit more if you look at inflation levels, if you look at the composition of inflation, which is different from the US.
So we talked about Jim Bullard earlier this morning, St. Louis Fed president, who put out the number of 7% as a potential worst-case scenario for Fed funds rates. He then went on to say, actually, he sees inflation coming down quite rapidly. If the U.S. were to experience that kind of disinflation, how much would that relieve the pressure from the rest of the world? How much of the inflation is being driven by the spending in the U.S. that you're seeing from the consumer?
So look, I would say, of course, the market is looking what the Fed has been doing, and other central banks, again, in this hiking cycle have been following, maybe a bit later. But I would say, again, if you look at the composition of inflation, it's, as I said, different in the US. Very strong labor market, not so much an energy price issue as we have here in Europe. So from that perspective, I would say central banks probably are differentiating a little bit and not just following the Fed around the globe. But of course, it's helpful. All the discussion about hyperinflation and the Fed being super high is then going away a little bit. So that should help in general on markets. But central banks have to still act on their, say, home local inflation.
Christian, you and I have textbooks that say 60-40 is an intelligent way to go. That's been blown up. What happens here? Does 60-40 reaffirm itself? 60% equities, 30% bonds, 10% cash, whatever. Does it reaffirm itself out next 3 years?
If you look through, right, I think this year, 2022, you've seen that massive drop in bonds and drop in equities, which is really rare. If you look back to history, it's the last time you saw something like this, 1800 something, 1788 actually. Whether you can trust the data is another question.
Wait, I was there. You can trust the data. I lived it. This is worse. Continue.
But if you look through, right, I think from the fixed income side, if we all could agree on lower growth, we even think there's a recession, but at least if there's lower growth, that should not be too bad for the bond side. And secondly, on the equity side, if I look towards the end of the year, say the 12 months forecast, I'm not too sure it's so bad on the equities, actually. So
there we go.
I think for 60-40 is not the worst year for 2023, actually.
Germanic optimism, as he will have for the World Cup as well. Christian Nolting, thank you so much. Global Chief Investment Officer at Deutsche Bank. Thrilled to have him on today. We've got so much to talk about. I've got to talk to Bramo about the wheelhouse, and that is did we see this week in this corporate spread market out to high yield, that off this curve inversion. If you're waking up, curve inversion, negative 69 basis points. That's Greek to me and you for global Wall Street. That's a wow statistic. Stay with us through this Friday. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Ukrainian forces continue to fend off Russian assaults in the east. Kyiv is enduring long periods without power following multiple attacks on critical energy infrastructure across the country. Meanwhile, Pope Francis said in an interview the Vatican is available to do, quote, everything possible to mediate. President Volodymyr Zelensky maintains that only the return of territory taken by Russia will allow an end to the war. A Swedish investigation into ruptures at the Nord Stream 1 and 2 gas pipelines finds the cause is, quote, grievous sabotage. The investigation will continue analyzing the sections where the damage occurred and explosive residue was found. Now, that pipeline, which crosses the Baltic Sea to Germany from Russia, is a focus of a probe by authorities in Sweden after 2 leaks were discovered. Meta has fired or disciplined more than 24 employees and contractors in the past year for improperly taking over user accounts, sometimes allegedly for bribes. That's according to the Wall Street Journal. And that report says some workers are accused of accepting thousands of dollars in return for giving hackers access to user accounts. A Meta spokesman told the Journal that the company will continue taking appropriate action against people that sell fraudulent services and target its platforms. Qatari officials are set to ban the sale of alcohol within the World Cup stadiums. That move is a dramatic reversal of an earlier decision to allow Anheuser-Busch to sell Budweiser beer. Bloomberg learned it will likely result in moving concession stands serving alcohol further away from the stadiums. The tournament kicks off Sunday with the hosts taking on Ecuador. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We're in the early stages
advantages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
Ultimately, we will raise rates to levels that bring inflation back down to our medium-term target in a timely manner. As I explained recently, how far we need to go, how fast, will be determined by the inflation outlook.
Christine Lagarde, unlike Draghi not putting a date on it, maybe we'll see that, Lisa, here coming up at certain ECB press conferences, but this not moved markets, but got the attention of all. Christine Lagarde speaking, Maria Tadeo's there, we're going to go to that in a moment. And Lisa, on a Friday, it's a reaffirmation by Lagarde of this linkage of economic slowdown to bringing inflation down.
You nailed it when you said the markets aren't really moving on this. They're done with this. They've heard this before. They're just sort of like, okay, yeah, we know, and we're going to go where we think we go, and we don't really believe your trajectory. We're going to go with ours.
We're going to frame out here. Anne-Marie Horton with us in Indonesia, working our way back to America. We'll talk of Speaker Pelosi here in the next hour. Maria Tadeo in Frankfurt as well. Maria, Lisa wants to go to the Lagarde story and what you're visiting at. I want to go to the fact winter is here. I looked at the weather report in Ukraine, and Maria, this is not funny. For the next 4 days starting Saturday, it's 23, 24, 25-degree lows. How does this war change that winter is here?
Look, winter, and not just in Ukraine. And in fact, Tom, I love that you mentioned that, because we're about to see the first big cold spell in Europe too. Temperatures are going to go minus in a country like Germany. So that, again, we get the winter factor that now fully plays in. Also, particularly in Ukraine, it's pretty obvious now that, well, the Russians realize on the battlefield it's complicated to push back. The Ukrainians have been pretty good, actually, indeed, doing the opposite. The counteroffensive has worked in the favor of Ukraine. So Russia now targets the infrastructure. That means Ukrainians could freeze this winter. We heard from the electricity operator yesterday that says 40% of the grid has been damaged already. That's why you see these missile strikes happening across the country. This is now a Cold War in the sense that the temperature now is a factor that Vladimir Putin wants to really use and inflict maximum pain, not just in Ukraine, but also here. Remember, temperatures are going to drop for the first time this weekend.
And Maria, dovetail this into the central banking conference where you're at, where all of the world's or European central bankers come together and try to figure out a path forward. How much are they winter dependent? How much are they Ukraine dependent? How much do they talk about the exogenous factors and how that affects how restrictive they have to go, how much they have to hike rates?
Yes, and look, this is a good conference because you have the central bankers, but also the bankers here. The Deutsche Bank CEO is right there, and I believe, in fact, he was chit-chatting with Christine Lagarde at the break. But she did talk about this. She talked about the energy factor. She talked about how the bills, of course, play into inflation. That's why we continue to see inflation go up. Everyone in Europe that I know, including myself, by the way, I've seen my bills go up pretty much every month now for 3 months. And of course, that plays into their mandate. She repeated, she insisted, we have to get to our 2% target. We are going to continue to hike. There is potentially a recession that will manifest, but nonetheless, we need to hit our mandate that is 2%. So the message from me today in this conference is that even in a recession, the European Central Bank come December will hike again. They will hike into a recession. The question is 50 basis points, 75 basis points, but the direction of travel is very clear. She laid it out today very clearly. We have to hike, even though we're potentially going to be in a recession.
And Anne-Marie Horton, we've been talking about the collision course that we've been seeing so far from the monetary policy and the fiscal policy makers, the Congress members in the U.S., politicians around the world who do not want to see people lose their jobs. It is bad for them, who don't want to see the economic pain. But right now, it's okay because the pain hasn't gotten that deep. How much has that pushback really spread beyond just a small cadre of people in Congress right now?
Well, it has already spread within the Democratic Party, right? This was the voices of, say, you had independent from Vermont, Bernie Sanders and Elizabeth Warren really starting that. But then also, as of October, before the last Fed decision, you had top Democrat Sherrod Brown writing this letter to Chair Powell saying, do not forget about the unemployment market. We don't want to see the risks of jobs as you go on this aggressive campaign to fight inflation. Basically, make sure the medicine is not worse in terms of the cure. We want to make sure that at the same time you're fighting inflation, you have to keep the employment picture positive. And what you're going to likely see, and now we're going to have a split Congress, is that potentially this will grow louder on a bipartisan basis. Republicans will likely use the inflation story to continue to attack the Biden administration, but I don't think that means the Fed's out of the clear from some swipes from the GOP either.
Emery Horton, thank you so much, and safe travels. I believe we'll see Ms. Horton here in the next hour as well. Maria Tadeo, thank you so much for joining us from Europe today. I want to dive into the world of Bramo. We can do this on bonds. There's full faith and credit, there's quality corporates, there's garbage, and then there's high yield distress, and none of them are ever talked about. The media takes total focus on full faith and credit. What's the 10-year doing? Blah, blah, blah. In all this uproar, including inversion now 69 basis points, how is the relationship of garbage to quality corporates moved this week?
You have seen a greater rally in higher quality corporates rather than the garbage, as you say. I thought you were going to say we're going to dive into the world of Bramo, and it's super depressing. So get ready for the world as winter is here in your headline that you had earlier. But how much are we looking at really a lack of recognition in the credit markets, akin to what some people say in certain pockets of the equity markets? People are still looking for yield. And I think that you can see companies that still have cash piles, that still have debt that they don't have to refinance. So it hasn't hit them as quickly, which is one reason why you haven't seen those defaults yet.
I don't want to catch you unawares here. Lisa and I, we don't rehearse this, folks. Me, John, and Lisa, we just
we don't even
come
talk.
in and talk. We don't talk. Well, we don't talk because we can't stand each other. That's a different story. But this week, something happened from my ute. There was a bond offering involving leverage buyouts, private equity, whatever, where the paper sat on Wall Street's desk. They couldn't sell it. Raptor on Tenneco and Apollo was involved as well. And I don't want to get into the gossip of it, but what's its signal when you're doing transactions and paper sits on the desk of Wall Street?
It's been happening more and more. There are billions of dollars still sitting on Wall Street balance sheets. Yeah, I mean, the latest was Twitter,
I'm surprised this isn't more in the zeitgeist.
But we talked about that with Twitter, and if you want to bring it down to one story, what happens with all the Twitter debt on bank balance sheets right now? What, $12 to $14 billion, especially as you see this complete eradication of valuation, at least perceived in the exodus of staff and some of the concerns about, advertisers, et cetera. What does Wall Street do, right? And the theory is that
they lowered the price and the yield goes up, making it more attractive, but even then they can't move it.
From a bigger standpoint, banks are not going to collapse. U.S. banks are not going to collapse, but they might restrain lending to corporations, to consumers. And that's, I think, what people are looking for, a withdrawal of credit from the world rather than any kind of potential vulnerability.
Good news, the VIX in 23.73. That's attractive off the last number of weeks. Are we still in a bull market rally or an intermediate bear market rally? Who knows? Futures up 24. Stay with us. Bloomberg Surveillance.
says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Bloomberg Surveillance on a Friday. Jonathan Farrell, Lisa Bramlett, and Tom Keene. Mr. Farrell on assignment. Hope he's doing well. We are here on an historic Friday. Really, for those that went to bed early last night, just waking up in America, it is a Twitter under threat. We're working on that story right now. Lisa, this is an evolving story. I haven't seen many headlines in the last 10 minutes, but even in the last 2 hours, Joe Weisenthal, the stalwart, what did I miss, woke up, and even Joe is out there wondering if this is the last day of Twitter.
Well, and this is because of the exodus. Interesting to see some Democratic senators put out a letter overnight, basically asking the U.S. Federal Trade Commission to look into whether Twitter breached certain consumer protection laws because of some of the turmoil. You're seeing this with European regulators saying that they need to install some moderators. So there's a whole host of back and forth from regulatory agencies as well.
Futures up 25, Dow futures up 145. Nice lift to the market. It's not a Friday lift. It's just sort of like for real. And I'm going to link it with oil showing economic slowdown. Brent under 90. West Texas Intermediate, 81.38, and yield a little bit of an elevation there in the story of the week curve inversion, negative 69 basis points. We went out to find an expert on Twitter. His first trade was done by Carrier Pigeon a few years ago. Andrew Sliman joins us, Senior Portfolio Manager, Managing Director, Morgan Stanley, here to pick up the pieces. Andrew, I love your note. You go, shut up and look at the other 490 of the 500 S&P stocks. Where's the value?
Well, the fact is the market might be down, 20-ish%, but most stocks are down a lot more than that. And the cap-weighted index has been held up by the really big boys, and the rest of the stocks are down much more. And so when people say, well, Andrew, do you think we're going to have a recession next year? I say there's so many stocks out there that already reflect a recession. So, I think there's less downside if, in fact, a recession or an earnings recession especially comes to fore.
I'm assuming that a grizzled veteran like you is linking value, PE, forward PE, with persistent quality free cash flow. Where do you find that among the beleaguered 490?
Well, you're absolutely right. I think, at the end of the day, I'm a believer that wage inflation is here to stay. I think ultimately we won't get to 2%. And that means over the next, you name the years, 5-7 years, I think what you pay for something is going to be as important, if not more important, than the growth rate of a company. And so when I look through, there are a lot of stocks that, as I said, are down. Now, value, obviously, there's a lot of value stocks. Financials, I think, are very attractive. But I'm intrigued by some of these consumer discretionary stocks. I know that's hard to believe, but with consumer sentiment at a 40-plus year low, that is very negative. And so eventually the direction of change is inevitably going to move the other way. And can I find some stocks in that area? And I think a lot of these interest rate sensitive stocks that have gotten killed because mortgage rates are up, I think that is, if we get rates start to come down, even though their businesses might deteriorate, they trade at such low multiples in the home area, I think that's attractive. So it's not just value stocks. There's some growth areas that have really been beaten down, killed. I think tech's been beaten down, but a lot of those multiples still seem a little high to me.
So I don't want to create drama, and I realize that Morgan Stanley Investment Management isn't Morgan Stanley, the investment bank, but you differ quite substantially with Mike Wilson, your peer over at Morgan Stanley, who thinks that there is probably another leg much lower and that we are reaching perhaps the last gasps of this bear market rally. You think that we have further to go, that there's something more substantial. Where do you guys disagree? I mean, do you guys sort of sit on opposite sides of the lunchroom, or do you guys hash it out and have some sort of, agree to disagree kind of moment?
Yeah, no, Mike's a good friend of mine, and we sit on a committee together. Where I've disagreed with Mike this year is the earnings story. I thought that earnings would come through strong this year, and they have, but he's been more right on the Fed pivoting and the effects of the PE compression. I think he's going to directionally be right next year in terms of earnings are too high. And the S&P cap weight, he might be more right. All I'm saying is, look, if you say, are you bullish on the S&P cap weighted? I'm not all that confident on that. I just think there are a lot of other stocks from a stock picking standpoint that are a lot more, the outlook is very positive because of where they've come down. So I'll let him call the S&P cap weighted. I do think he's going to be right direction on earnings revisions. I just think if the Fed eventually takes their foot off the brake, you're going to see some PE expansion for some of these areas that have been so compressed. I'm not sure it's the S&P cap weighted.
What does that mean then, Andrew, with respect to your view on tech? Because that seems to be the big delineator between the market, the